Hey traders, investors, welcome back to the audiobook, Maximum Trading Gains with Anchored VWAP. We now continue from Chapter 6 through Chapter 12, where the book dives deeper into advanced strategies and practical applications of Anchored VWAP. In this section, you'll learn how to identify new anchor points in a trend and use the handoff technique to stay aligned with market momentum, the debate between buying pullbacks or breakouts, and how Anchored VWAP helps you make clearer decisions. Why multi-day AVWAPs can be a powerful tool for short-term traders looking for precision entries and exits. How to navigate gap trading with AVWAP to avoid traps and find high-probability setups. The dynamics of short squeezes and how AVWAP levels reveal when pressure is building. How to approach IPO trades using Anchored VWAP for structure in an otherwise uncertain environment. And finally, a closing chapter that ties together these methods into a disciplined, profitable framework for traders at all levels. Let's continue the journey into mastering Anchored VWAP, beginning with Chapter 6, New Anchor Points in a Trend, the Handoff. Chapter 6, New Anchor Points in a Trend, the Handoff. We ought neither to fasten our ship to one small anchor nor our life to a single hope. Epictetus. Chapter Objectives. 1. Define handoff. 2. Identify a handoff in uptrends, downtrends, and in all time frames. 3. How to time entries and exits using handoffs. 4. When to combine handoff and pinch. As we have learned, primary trends rarely move in a smooth line. They slow down and speed up at various points before an eventual reversal. This is why we will have multiple anchor points on a chart. When a trend accelerates from the original anchor point in either direction, it is useful to create a new AVWAP to help measure the renewed momentum. This gives us the ability to better define and manage risk for existing positions, as well as for new entries. We anchor a new AVWAP when a trend begins to accelerate after the original AVWAP was touched or nearly touched. This is our handoff point, a term I coined. A handoff helps us to visualize and take advantage of the changes in the rate of momentum in a primary trend. We leave the original or preceding AVWAP on the chart for future reference because the stock will often find support in uptrends or resistance in downtrends at or near that original handoff point. In this chapter's charts, you'll see my own best practice of changing the new AVWAP's color with each new anchor point. Handoffs in an uptrend. The best tool I have to explain handoffs is through example. Please look at the chart 6.1 and follow the comments. This stock was in a downtrend, A, prior to the low 1 in April. We can't know that 1 is an important level either high or low until the price moves significantly. At 2, the significant upward movement away from 1 indicated that 1 was an important low. This is when we set our initial anchor 1. As the stock progressed higher over the next several months, the momentum remained until the pullback in October 3. Since the stock quickly bounced from the original AVWAP green and showed renewed upward momentum from 3, we set a new anchor and a new AVWAP in blue, 3. The handoff has just taken place from green to blue. The stock continued to show strength for the next 8 months until a pullback in August 4 saw a test of the blue AVWAP that had been anchored at the first handoff 3. At 5, the stock bounced from our blue AVWAP, indicating a more aggressive source of demand. By setting a new anchor at 5 and using red as the color for the newest AVWAP, we can capture the essence of the demand. The second handoff has taken place, 5. At 7, the stock continued down to the blue AVWAP that we had anchored 3 and once again found buyers. As the speed of the upward momentum increased, we recognized a new control point to hand off with another AVWAP in purple, 7. When we have several handoff points on the chart, it looks like there are different layers of trend to measure, which is why we can also refer to an AVWAP handoff as layering. Going deeper, entry and exit with uptrend handoffs. Chart 6.2 uses a different stock to show how to implement handoffs. Our goal is to enter an existing trend at low risk, high probability points. This is an important strategy that helps us avoid FOMO purchases and take unnecessary risk by entering with renewed momentum. At 1, the new uptrend begins for the stock in chart 6.2 and the green AVWAP is anchored there. Notice that there are 2 handoff points 4 and 8 chosen several days after the stock touched the green AVWAP, and more invigorated buyers appeared. The smart trader would choose these handoff points to anchor new AVWAPs, blue at 4 and purple at 8, in light of strong price movements away from the touches. These handoffs show a renewed commitment of buyers, which makes them important levels. The chart shows several examples, green dots, of where we might want to purchase this stock as it came back to test the blue and purple AVWAPs from the handoff points. The even numbers without dots 2, 4, 6, 8, 10, and 12 show where people who purchased at the pullback to the most recent AVWAP may have purchased. All the instances except 12, buying as the stock first touches the AVWAP would have resulted in a profitable trade. Yet, 12 showed no significant bounce and instead failed, which would have resulted in a loss. As stated in earlier chapters in the book, the point of first contact with the AVWAP is a point of interest, not necessarily a safe trigger point to place a trade. The green dots associated with the odd numbers show purchase levels after the AVWAP was tested. If you purchase at the green dots, you could place a stop below the prior blue arrow at the prior even number. For instance, if you purchased 7, the most recent relevant higher low was 6. Place the stop under that level. Notice there is no number 13 above. No, it's not because the number 13 is unlucky. There is no 13 because the stock failed to show the proper strength to bounce higher from the AVWAP. As we studied with support and resistance in Chapter 2, when the price touches the previous AVWAP, it is up to the trader to decide if they want to purchase a new position or add to an existing position. The best purchase option occurs when the stock moves away from the AVWAP touch as new price momentum develops. My preference is to buy if the stock shows renewed momentum. This will allow me to purchase with a price trend in my favor from the start, and with the bonus of a logical place to set the stop. Risk management is always on the mind of the most successful traders. At times, we need to remove an anchor if a significant price move did not develop and the stock turned sideways. This helps keep your chart uncluttered. Once you have more experience with the anchoring process, this will become more intuitive. Handoffs in a downtrend. Just as support and resistance are mirrors of each other, the handoffs in uptrends and downtrends are similarly opposite. Chart 6.3 shows handoffs with a stock in a downtrend. The stock in Chart 6.3 gapped higher at opening 1 and failed to hold the gains from that gap. The time wasn't right to set the anchor point until 2, when the stock made a lower low, at which point we set the anchor point to 1. Remember, we look to anchor at a logical point, such as a lower high on a downtrend or a higher low on an uptrend. Then the stock rallied up to the red AVWAP 3 and turned sharply lower. This is where we set our first AVWAP handoff purple. As the stock continued lower, it experienced a failed attempt to move higher 5. At 4, the stock made a lower low, so we began another AVWAP handoff blue back 5. Only set an anchor once you realize that the stock reached an important level. This means we will always recognize the handoff after the move is underway. At 7, the stock ran into the blue AVWAP from 5 and continued back down. There is an option to short the stock 7 as the stock drops away from that level. However, it was only 6 that enough time and activity had passed to allow us to intelligently identify and create a new handoff, black 7. The next handoff, light blue, was placed 8 after the stock failed to push up through the prior black AVWAP handoff. Going deeper, entry and exit with downtrend handoffs. As we will explore in the next chapter, entries for lower risk short sales occur when the stock has downward momentum. Chart 6.4 shows entries and stop points for short sales. Notice how the handoffs do not always touch precisely on the prior AVWAP. This is intentional so as to show that not all trade opportunities are traditional textbook examples. This stock is in a stage 4 decline C, chart in Appendix A, and shows where the first AVWAP red is anchored 1. We set the next anchor purple 2, but this was not an official handoff because prices didn't touch the first red AVWAP. We set it 2 because prices moved steadily lower from that point. Do not expect perfection in any aspect of analysis or trading. Our goal is to capture the essence of trend, not argue about what qualifies in a textbook as a handoff or any other concept. The art of analysis and trading allow for interpretation within reasonable guidelines. At points 4 and 6, there were official handoffs from the previous purple AVWAP 2. More important than what qualifies as a handoff is the opportunity to enter this stock with a short sale. The odd numbers, associated with the green dots 3, 5, 7, 9, and 11, show where we could enter a short position as the stock gathers momentum to the downside. The choice to enter the short trade is the same as when we buy a stock. Do we short at or around the touch of the important AVWAP, or wait for prices to turn away from the AVWAP. An entry at either of these 2 points would allow for a stop just above the prior peak, marked by the even numbers. For example, we could protect a short sale entry 7 with a stop above the prior peak 6. If we sold the stock short 7, and then it happened to increase in price above the prior high 6, the definition of the downtrend, lower highs and lower lows, would no longer exist, so we would cut our loss at that point. The first official entry as this stock touched a prior AVWAP would have occurred 5, with a stop above 4. The entries 6, 8, and 10 would not have had a most recent and relevant lower high nearby to protect the position with a stop, which makes these entries riskier. Handoffs in all time frames. As always, it is worth a mention that these AVWAP handoff concepts apply to all time frames. The principles of the handoffs apply from longer-term investing all the way down to day trading from a 1 or 2 minute chart, as shown in charts 6.5 and 6.6. Chart 6.5 shows 2 trade days for one stock. On the first day, the stock was strong from the start and never pulled back for a test of the daily VWAP. On day 2, the stock pulled back 2 to the green AVWAP from day 1. It can make a low-risk purchase 3 represented by the green dot, with a stop below the low on the test of the green AVWAP 2. As the stock moved higher, we would hand off a new AVWAP blue 2 and stops could then be raised upon to points 4 and 8 as the stock made higher lows along that AVWAP. We could make a new purchase 5 with a stop 4. This is also where it made sense for a new handoff purple 4. We could set a more aggressive stop 7 as this was the test of the second AVWAP handoff, which is where we had anchored the third AVWAP in purple. At 8, the stock would be stopped out for a day trade gain of about $0.50 per share. In chart 6.6, a one-day timeline still at 2-minute intervals, this stock was weak from the start of the day. The daily VWAP red from the start 1 found sellers 2. We anchored a new AVWAP in blue. We had 2 entry choices here. 1. Sell the stock short as it touched the daily VWAP 2. 2. A safer choice is to sell the stock short near the red dot 3 as the stock fell away from the daily VWAP. No matter our choice, we would place a protective stop just above 2. The stop would then get trailed down to just above the highs represented by the red arrows. Notice how points 4 and 5 were also the basis of new handoff levels as the pace of the decline sprinted away from the previous AVWAP handoffs. The red dots represent alternative entry points on this day. Going deeper, combine the handoff and pinch. Once you learn to recognize one AVWAP strategy on a regular basis, you will begin to notice that other strategies will show up on the chart. Now we can look at how the handoff and pinch work together. If you missed the original trade, there are often new purchase points after an AVWAP handoff. When this happens, you will see alternative entries at handoff points. The stock in chart 6.7 started with a buy opportunity as it broke a pinch 3. This might look overwhelming, but follow the chart AVWAP to AVWAP. Each is a different color to make it easier to follow price action. We placed the anchor 1, the opening price, then we waited out the downtrend to find a reversal indicated by the new higher low 4. When the stock climbed back above that AVWAP 3 and buyers regained control, then we would set a new AVWAP in green to the low 2. The stock broke beyond the upper AVWAP red to create a near-term higher high 3. At that point, we could buy the stock with a stop below 4, the most recent and relevant higher low. As the stock climbed, we would raise the stop up under the successive higher lows represented by the green arrows. When the higher low 5 is broken, the stop is triggered represented by a red dot. At 6, the stock continued down through the green AVWAP from 2 and below the red AVWAP from 1. A buy at either of those 2 AVWAPs would have resulted in near-term losses. A purchase near the green dot 7 would have been in a profitable position right from the start. As it showed the near-term strength, we can anchor a new handoff point and purchase the stock. You may notice the purchase 7 is almost identical to the prior exit and wonder what the point of making 2 trades was. If the stock was purchased 3 and held through the sell-off 6, the trade would have temporarily gone negative. Notice that the price dropped from $105 A to $87 B on this sell-off. This was a severe drop. The original purchase was near $88 3 and the exit would have been at $95, a gain of 7 points or just under 10%. Peace of mind that comes from taking a profit before the stock drops significantly is reason enough to be out of the stock. There was no assurance that the stock would recover and turn higher. Locking in the gain was the smart thing to do. The purchase, 7, put you back into the stock when the momentum was positive. Every swing trader wants to be in stocks with strong trends, lock in gains when the momentum slows or reverses, and avoid the negative periods. Notice how the next pullback from 7 found buyers right along the first handoff 8. Once the stock continued back up through $100, we created a new AVWAP handoff 8, and that AVWAP continued to hold up to the end of the chart. The green arrows represent the higher lows under which we can raise our stop levels from the purchase, 7. At the end of this chart, the stop would have been at approximately $111 from the purchase near $94. Key takeaways. It is normal for the rate of change in a trend to slow down and speed up. We set new anchor points from the levels buyers and sellers become more aggressive. Multiple handoffs look like layers as the point of control changes with renewed momentum. AVWAP handoffs can be used to trade more accurately on all time frames. A handoff level can often become the anchor point of a new pinch in a trend. Chapter 7. Buy pullbacks and breakouts. Whenever you find yourself on the side of the majority, it is time to pause and reflect. Mark Twain. Chapter objectives. 1. Recognize a pullback. 2. Recognize a breakout. 3. Don't buy the dip, buy strength after the dip. 4. Know the difference between a dip and a downtrend. 5. Don't short the rip, short weakness after the rip. 6. Understand why some breakouts fail. 7. How to manage risk. With an understanding of how a trend's rate of movement changes, we can now examine two popular strategies, buying a breakout and buying a pullback. A couple of simple adjustments to the general pullback and breakout trade strategies will make these strategies much more profitable. Of course, the improvements to these strategies come from the addition of AVWAP analysis. Pullbacks. Nature of markets is that they experience a directional thrust and then either consolidate sideways through time, meaning that the price stabilizes and stays within a somewhat narrow range, or they experience some short-term profit-taking, which creates a pullback. A pullback is also often referred to as a dip. One of the basic foundations of technical analysis is that a trend, once established, is more likely to continue than reverse. Because of this fundamental rule, it's important to study pullbacks carefully. After any period of frenzied trading, calmer heads need to prevail. Recall what we learned in Part 2, Chapter 2 about support and resistance. Each is only identified with certainty in hindsight. Pullbacks are akin to this. We give a pullback the benefit of the doubt and prepare a purchase, but if it continues to decline in price, we do not participate. The re-emergence of trend on the shorter time frame is our opportunity to take part in a low-risk, high-probability trend continuation trade. This is the basis of trend alignment. When the trend on the longer time frame is still intact, we should treat pullbacks as innocent until proven guilty. However, if the pullback continues to a point where the longer time frame no longer exhibits a pattern of higher highs and higher lows, we should abandon the setup until it aligns on multiple time frames. Don't buy the dip. We often hear buy the dip as a strategy to purchase a stock. This refers to the desire to buy a stock that is in a longer-term uptrend as it experiences a near-term price correction, a pullback. It makes sense to want to buy the dip. We want to pay less than the recent high. Trading activity corrects the strong momentum, then pauses and can then either turn back higher or fail. The possibility of trend failure is why we do not blindly buy on a pullback. Buy strength after the dip. Instead, we want to anticipate what is most likely to happen next to the stock and create our trade plan as its price drops to a level of interest. We wait for price momentum to confirm that the selling has subsided. Then, when buyers regain control of the short-term trend, we take part in the emergent strength, i.e., the price movement upward. This is the essence of trend alignment. We want to buy as the stock moves back up above the AVWAP from the prior high. It tells us with absolute certainty that buyers have taken back control from the prior high point. We do not have to guess. When the price is above the AVWAP from the recent peak, it means the average buyer from that point is now in a profitable trade. Also, the average short seller will be in a position of weakness as their average sale price is below the current level. There is no technical tool better than AVWAP to identify the transition of power from buyers to sellers and sellers to buyers. Let others pave the way and create a near-term level of support before you purchase strength after a pullback. Imagine you are at the beach, and there is a group of people standing on top of a cliff peering over the water, tentatively deciding whether to jump into the refreshing water 40 feet below. No one has jumped from this cliff before. As a thrill seeker, it might tempt you to jump, but do you want to be the first to make the leap? What if there is a rock just below the surface that you cannot see? Of course, no one should jump if it is unsafe, but if you are going to go, don't you want to make sure that no one gets hurt before you do? Let others take the big risk. Use a smarter approach to risks in the markets and in life. Chart 7.1 shows why we do not blindly buy a dip in an uptrend. There were 3 dips in this stock's strong uptrend. The first dip, 1, saw the stock drop from $29.20 to $22.60, a 22.6% drop in 3 hours. Imagine how you would feel if you bought the pullback, such as when the stock was $28, $27, $26, $25, and the stock continued down to $22. The second dip, 2, saw a smaller decline from $29.50 to $26.77, just 9.3% in an hour and a half. The third dip, 3, saw the stock drop close to 50% in just 6 days. If instead of buying on weakness, you waited until the stock got back above the AVWAP from the prior peak, one of the green dots, you would have made your purchase when buyers controlled the trend. Notice there is no green dot after the peak at $34. The stock never got back above the red AVWAP from that peak, so no purchase would occur. Rather than give in to emotional thoughts like it's down too much, a disciplined approach would have kept a buyer from buying as it declined from $34 all the way down to $17 and taking a large loss. You will never buy at the low when you buy on strength, but you will avoid unnecessary losses and you will have a logical place to set your stop. Not all dips end up being a simple pullback. They can represent trend failure, which is why we wait to buy strength after the dip. Do not buy stocks in downtrends. As we see in the chart 7.2, when the 50 DMA is sloped lower, the weakness is not a dip. It is a stock in a downtrend, and it should not be considered for a long position. Many people try to buy a dip in a stock in a downtrend. That is simply wrong. It is not a dip purchase if the stock is in a downtrend. It is buying a stock that is more likely to continue lower than it is to reverse. The accumulation process, stage 1, seen on the market structure chart, can take months or even years before the stock is ready to turn higher again. If the collective action of buyers and sellers don't scare you out in the decline phase, they will wear you out in the long accumulation process. Don't waste your time and money buying stocks in downtrends, no matter how low the price is relative to recent history. Don't let FOMO rule your decisions. Wait for buyers to re-establish control before you participate in the trend. Many traders give in to the temptation to buy a stock in the decline phase, which is a type of FOMO. They see the stock rally from a certain previous level and cannot stand being on the sidelines as it reaches this bargain price again. Each little bounce in the downtrend gives them hope the stock has made a low, only to be disappointed when the stock eventually cannot hold the temporary gains. Market psychology. Support and resistance in the rearview mirror. It is not possible to know if the stock will find support and turn higher, or if the dip will turn into a larger, more serious bout of selling that leads to a reversal of the primary trend. We should wait for the odds to be in our favor when we purchase a stock. Would you rather guess a low or buy the stock when we know for fact that buyers have control? A buy above a flat to rising AVWAP gives us certainty that buyers are in control. When we purchase at potential support levels, areas of interest, the risk is that the support will not hold, and there is not always a clear level to set our stops and limit any loss. We never know how far the price will continue to fall, which makes risk management a guessing game. A more professional approach is to wait for objective levels to form on the chart, buy strength after the dip. We should view a price pullback to a level of interest as a potential opportunity on the chart, not a place to buy the stock. This area of interest guides us to look for a shorter time frame for evidence that buyers have regained control. Don't short the rip. Stocks in a downtrend are just the opposite. We hear people say sell the rip in a stock in a downtrend. The problem is what constitutes enough of a rip to sell short and where to set the stop to protect against large rallies and resulting losses. We examine this in chart 7.3. Chart 7.3 shows the danger of selling the stock short too early. Where would you have shorted the strength of that stock as it rallied? Would you sell at 11% in Area 1, the 14% rally in Area 2, or the 17% rally in Area 3? It is safer to short after the peak, and the stock breaks below the AVWAP of those rallies, red dots. When we short with the downward momentum in our favor, we reduce the price risk because we have a safe place for our stop, above the most recent lower high. This approach helps us leverage time because we do not have to guess when the sellers have taken back control. Breakout trades. Stocks that break out of narrow price ranges can provide some of the most dynamic price moves. It is wise for traders to look for stocks that are near a breakout level, and then monitor those stocks on shorter timeframes for clues that they might be close to their own respective momentum moves. It is quite satisfying and profitable to buy a stock right at the start of a new trend and hold it for large gains as the trend remains intact. This is the goal of trend trades, defining a breakout. There are many versions of a breakout. Typically, it refers to a move to a new high in the time frame we are analyzing the stock. Many of us learn to buy the breakout, but what is a breakout, really? If a stock rallied 10+% in 4 days, is it a good breakout? Always remember to answer these two questions: where it has come from, and where does it have the potential to go? Don't paint all breakouts with the same brush. The break past a narrow price range can offer a great opportunity for trend continuation. We can buy those stocks, but as always, with a stop set in case the trend reverses. Many times, I observe people on social media referring to a breakout in a stock that technically has already made a higher high. They don't understand that the quality of the breakout is riskier than it might appear. Narrow price ranges produce higher quality breakouts. Riskier breakouts typically emerge after the stock has made a large percentage prior move. It is a matter of where has the stock come from. If it has used a lot of energy to get to the point of breakout, it will be more difficult to keep risk to a minimum. Charts 7.4 and 7.5 show different stocks on daily charts and breakouts with different risk parameters. The stock in chart 7.4 shows the type of stock we want to buy on a breakout. This is a low-risk entry point because it comes from consolidation out of a tight range. The green dot near $72.50 was a good entry because the stock had spent little energy prior to the breakout point. Chart 7.5 shows another stock with two different purchase points in green ovals. When the stock crossed above the purple AVWAP from the prior high 1, we knew that the average long participant was profitable and the average short seller was in a losing position. This is where buyers took control and is the optimal place for a low-risk purchase. We did not know if the buyers would remain in control, so we would set a stop just below the gap, near $27.00 too. As the stock progressed higher, we would raise the stop under the successive higher lows green arrows and might have gotten stopped out near $29.73 3. The second entry, 4, shows the breakout to the new high. A purchase there would have been made at $29.75. The breakout 4 is higher risk because the stock had already made a large percentage move prior to that entry. Those who purchased on the breakout 4 arrived late to the trend compared to the buyers above the purple AVWAP anchored 1. The difference between these two purchases was a profit of approximately 9% purchase at 1 to stop at 3, and a break-even trade purchase at 4 and stop at 3. It is often taught that you should place an initial protective stop based on a fixed percentage, 3% or 5% from the entry point. Although better than no stop strategy, the best approach is to set stops based on the definition of trend. When we buy a stock as it breaks past a near-term resistance level 1, and the stock is in alignment with the larger time frame trend, we want to place our stop below the most recent and relevant higher low. If it breaks that low, that is, the price drops below that low, the emergent trend has failed because the definition of the uptrend, higher highs and higher lows, no longer exists. Why would you want to continue to hold that stock? Get the entry right. The ability to hold a winning trade is largely a function of where you enter the stock. Are you in a position of strength or weakness from the start? Success is often simply the difference between a well-planned and executed trade at a strong, analytically supported entry point and a weak, emotionally determined entry point. And guess what? That really is the difference between a professionally executed trade versus an amateurish entry. The number one consideration when you make a purchase is where your stop will go. If you are wrong, you want to be able to limit your loss. The closer the stop is to your entry, the more shares you can trade, which magnifies the upside potential. Advantage of the AVWAP entry versus buying dips and breakouts. Chart 7.6 labels 5 different moves. In each of these 5 pullbacks dips, there are several choices where to enter a long position. We review the pros and cons of each of 3 different entry techniques below. In Chart 7.6, the red highlighted areas show pullbacks. A. Green dots B show buy points where the relevant AVWAP is crossed, and the black arrows C show traditional breakout purchases. Entry A. The red shaded areas show where a pullback buyer would look to make a purchase. As we know, it is a guessing game to buy the low in the stock as the decline is underway. This entry does not protect us against a potential reversal into a longer-term downtrend, which could result in large losses. Entry B. The green dots show the ideal point to enter the stock as it crossed above the AVWAP from the prior peak. This is where we know with certainty the buyers have regained control from the previous high. A purchase here assures us that momentum is in our favor, and we also have a logical place for our stop, underneath the pullback low. This is called the AVWAP cross purchase. Entry C is the traditional breakout buy as the price makes a new high. As you can see, the breakout points come much later than the AVWAP cross-purchase buyers. As an example, the first AVWAP cross-purchase was at $6.50 versus the breakout buy of $7.74. Not only was the AVWAP cross-purchase $1.24, or 19%, lower than the breakout buy, the stop could have been tighter, less cents per share, than the breakout purchase. Study the other purchase areas at the green dots to compare the advantage of the AVWAP cross-purchase to the other entry, pullback, and breakout techniques. Advantage of the AVWAP entry versus shorting rips and breakdowns. Chart 7.7 labels 5 different moves. In each of these 5 rallies rips, there are several choices where to enter a short position. We review the pros and cons of each of 3 different entry techniques below. The red highlighted areas, A, show counter-trend rallies in the overall downtrends. The green dots B show short sale points where the price crossed below the relevant AVWAP, and the labels C show traditional short sale breakdown to new lows sales. Entry A. The red shaded areas show where a short seller on a rally rip would look to enter a short position. As we know, it is a guessing game to short the high in the stock as the rally is underway. This entry does not protect us against a potential reversal higher, which could result in large losses. Entry B. The green dots show the ideal point to enter the stock as it crossed down below the AVWAP from the prior low. This is where we know with certainty the sellers have regained control from the previous low. A short sale here assures us that momentum is in our favor, and we also have a logical place for our stop above the rally high. This is called the AVWAP cross short sale. Entry C is the traditional breakdown short sale as the price makes a new low. As you can see, the breakdown points come much later than the AVWAP cross sellers. As an example, the first AVWAP cross short sale was at $160.50 versus the breakdown sale of $140.45. Not only was the AVWAP cross short sale $20.05, or 14.3%, higher than the breakdown sale, but the stop could have been tighter, less cents per share than the breakdown short. Study the other short sale areas at the green dots to compare the advantage of the AVWAP cross short sale to the other entry techniques. Market psychology, why breakouts and breakdowns fail. Breakouts. As we know, the markets discount the past and anticipate what is to come. Large stockholders who accumulate stock at lower prices often sell a portion of their stock on the breakout if the stock experienced a run-up prior to the break higher. Breakdowns. In a downtrend, short sellers will cover a portion of their bearish bets when the stock breaks to a new low when the stock already experienced a large move lower in the days prior to the breakdown. There is a phrase, sell or cover when you can, not when you have to. Smart money holders take advantage of the liquidity provided by the breakout chasers, people who buy when a stock makes a new short-term high after a large percentage move, and take profits on a portion of their position. This increased selling activity can result in the failure of a breakout in the near term. Be careful not to chase breakouts. Make the smarter entry when price crosses the key AVWAP so you can be in ahead of the crowd and with less risk. When you are involved in the stock before the crowd, it is a good idea to cash out a portion of your position as the breakout occurs. We want to trim a portion of the trade on strength and trail our stop with, or in the direction of trend, raise it up under the new higher lows. This is where you may have heard the phrase trim and trail, risk management. Our constant focus on where a stock has come from prior to our entry helps us determine whether a breakout trade is considered low or high risk. If a stock had a strong move prior to a breakout, it is less likely it will continue. We compensate for the higher risk with smaller trade size when we initiate our trade at the onset of fresh momentum. This puts the stock in alignment with the longer, more powerful trend, and we avoid the risk of time waiting for the move to happen. We also minimize the price risk and avoid unnecessary initial losses as the stock is in corrective mode. Key takeaways. When we buy the dip, we are in an immediate position of weakness because we are not sure if the buyers will quickly regain control. Wait for the upward momentum on the shorter time frame before making a purchase. This puts you in an initial position of strength. Buy strength after the dip. There is no technical tool better than AVWAP to identify the transition of power from buyers to sellers and sellers to buyers. Avoid the mentality that you are buying a bargain when the stock is in a downtrend. Stocks in downtrends are guilty until proven innocent. If we short the rip, we never know if the momentum will continue higher and cause large losses. It is better to wait for the stock to continue lower on the shorter time frame before we consider a short sale. Always remember to answer these two questions: where it has come from and where does it have the potential to go. The ability to hold a winning trade is largely a function of where you enter the stock. Are you in a position of strength or weakness from the start? Not all breakouts and breakdowns are the same. Consider how the stock got to the trigger. Where has it come from? Before you decide to get involved. The lowest risk entries occur when the short-term trend first comes into alignment with the longer-term trend. This is true for long and short trades on all time frames. Chapter 8. Multi-day AVWAPs for shorter-term traders. Follow the evidence wherever it leads and question everything. Neil deGrasse Tyson. Chapter Objectives. 1. Understand fresh momentum trend dynamics. 2. Identify low-risk entries into the second and third day price moves up or down. 3. Avoid costly FOMO purchases and short sales. 4. How to gain an edge on red to green buyers. 5. How to gain an edge on green to red sellers. There are many instances when a stock makes a significant move, but you didn't see it in time to get involved on the first day of the momentum. If the stock experiences a fresh breakout after the first day and looks like it may have room to continue further, it is not too late to participate. Even though I have seen the second-day strategy that we will learn about in this chapter play out thousands of times, it still amazes me how a prior-day AVWAP is often the exact turning point for a stock. The day after a stock makes a significant move can provide a low-risk, high-probability entry for those who watch the action closely the next morning. In this chapter, we'll learn from examples on intraday timeframes of roughly 5 days. Don't confuse the following information as applicable only to day traders. The principles used to find good entry points can be used for better timed purchases by longer-term participants as well. When you think you missed a move. Day 1. Why the stock moved. Don't get hung up trying to figure out the reasons behind the initial move. We're looking at price action. It may be a company reported earnings significantly different than analysts expected, a true earnings surprise. Surprise. In earnings news, general news, or from other sources can be thought of as a catalyst for price change that disrupts the balance of supply and demand. For example, if the surprise was good, earnings were higher than expected, many institutions will now want to buy a meaningful position. All this new demand needs to be filled, so the stock surges higher. On the day of the earnings report, they buy as much as they can, often aggressively, and the stock closes at or near the high of the day. When the stock closes near the high of the day, it may be short-term extended, used up too much buy power in the short term, and in need of a slight pullback, profit taking the next morning. Day 2. Upside price action follow through. There are 3 main players driving the market on day 2: profit takers, short sellers, and market makers. Profit takers, making the best of the large move, seek to capture profit on some or all of their long position by selling some stock at or near the high at the open. Short sellers, who do not believe the stock can follow through on downward momentum and sell accordingly. Their sales add downward pressure at the open of the second day. Market makers who need to purchase many shares on behalf of their clients may try to scare some supply loose by offering the stock lower than the previous day's close. For example, the market maker may have an order to buy 500,000 shares of the stock that day. To fill that order and get the best price possible for the customer, he may short some stock in the pre-market or right at the open. This initial selling gives the illusion the stock is weak and scares some long holders into selling stock to them at lower prices early in the day. The long holders would be doing this to capture some of their profits or cut losses. The market maker's goal is to buy more shares at a lower price than they sold short the initial shares. If they sold short 10,000 shares, but could purchase 50,000 shares at a lower price than the previous day's close, this would leave them with a net long position of 40,000 shares at prices that are likely to be near the low of the day. Of course, this is a risky game for them. They might end up selling too many shares at a low price and hurt their average execution price at the end of the day. How to take advantage of price action day 2 and beyond. Our opportunity comes in the morning of the second, or even a subsequent day for even the third or fourth day. If the stock opens lower than the previous day's close, we want to be ready to purchase the stock under these conditions. 1. If the stock can hold above the prior day VWAP, see charts on the next page, it shows buyers still have control from the start of the day the move began. 2. After the early morning weakness, the stock stabilizes above the 2-day AVWAP and climbs above the daily VWAP. This tells us the buyers have regained control of the trend for the new day and it is their game to lose. Here are the actions to take. 1. We purchase the stock as it climbs back above the daily VWAP and place our stop below the low. 2. If our stop does not trigger, we hold the stock as it increases and raise our stop to under the most recent and relevant higher low for the time frame we intend to hold the trade. Short-term entry tactics described above can be used to establish a position in the stock which might be held for a day trade or even a longer-term trade or investment. The more accurate the entry, regardless of the planned hold time, the more ability you have to set tighter stops and the more time you have with momentum in your favor. Chart 8.1 provides our first example of a stock with a strong move on day 1 that gave a low risk buy opportunity on day 2. The blue VWAP begins on day 1 and continues to be the second day AVWAP the next morning. On the first minute of day 2, the purple VWAP starts. It is the second day AVWAP. Keep in mind the prior day AVWAP doesn't reflect a full 2 days until the close of the second day. In the chart 8.1 below, you can see this stock opened on a gap higher near $73.50 on the first day. After a little uncertainty in the first 90 minutes, the buyers quickly established dominance by holding above the VWAP. We know the buyers had control because the price stayed above VWAP on a test just after noon, and the slope of the VWAP rose at that same time. The stock then closed near the high of the day at approximately $73.75. The next day, the stock opened close to $0.50 lower, as early sellers sold prematurely, before the stock had a chance to reveal if sellers had momentum. Savvy participants were ready to purchase shares at the VWAP from day 1. You can see, it wasn't a perfect touch 4 on the blue prior day AVWAP and rally, but buyers had been waiting in that area as the stock hovered near the level before price crossed back above both VWAPs. The initial volatility helped the market makers who were trying to scoop up as many shares as they could at the initial discount from the prior day's close. After a couple of minutes, it became apparent there were aggressive buyers waiting at that level. The stock quickly erased the initial down gap, then closed higher by almost $1. If you pay close attention to the stock on the morning of day 2, you want to buy if the second day AVWAP is still rising, and 5 the stock is back above the new day's purple VWAP at the green dot. A good way to confirm that buyers have regained control on day 2 is if the day 2 VWAP is now rising. This may happen as soon as the first 3 to 5 minutes of the new day, so you need to pay close attention. If you purchase the stock when both days VWAPs are rising, the momentum is in your favor. Once you have purchased the stock 5, the stop can go below the low of the morning 4. If that low breaks, it would mean sellers took control from the start of the move, and there would be no reason to continue to hold the stock. In chart 8.1, Buyers who waited for the stock to turn positive before purchasing it paid approximately $0.40 higher, 6, than those who bought the stock as it crossed above the daily VWAP, 5. If buyers 6 used a stop below the morning low, they would not have been able to buy as many shares based on the use of 1R multiple of risk as those who purchased at the lower price when the stock reclaimed the VWAP for the day, 5. Buy red to green. Many market participants like to purchase at the point stocks go from negative on the day, red, to positive on the day, green. When a stock is in a negative position compared to the prior day's close, it is red, and when it is in a positive position compared to the prior day's close, it is green. Notice, the Day 2 entry technique will get you in the stock ahead of momentum buyers who like to buy a red to green move. Here, the stock traded below the second day VWAP green for about 4 minutes 1, but held above the blue 2-day AVWAP. On the 5th minute of the second day, the stock crossed up through the green VWAP 2, which caused the slope of that VWAP to flatten and then turn higher. Looking at the inset, a purchase near $5.90 would have been quite reasonable, with a stop below the low of the day, 1. Back to the full chart, which includes the inset. The stock went on to a Day 2 intraday high of over $6.60, which means those who purchased 2 had the potential to take up to $0.70, 11.9% that day, or decide to hold for a longer period. For someone who makes the purchase here with the intent of a longer-term hold, they would have the comfort of a great entry from day 1 of the trade. Alternative entry technique. The next example in chart 8.3 shows a less than perfect setup because that is how the market works. Not every trade will follow all the guidelines for any strategy you use. Markets are risky. We pay the price of the unknown in exchange for the hope of a profit. Our edge comes from our strategies and risk management. If you want to experience consistent perfection in your trades, just stay in cash. Perfection does not exist. Chart 8.3 is a little trickier. As you can see from the inset box, the stock initially looked like it would hold above both the daily purple and 2-day blue AVWAP 1. Instead, there was a quick shakeout 2 about 5 minutes into the trading day. If you had purchased early, this may have triggered a stop. There are a couple of ways we could have avoided the frustration of an early loss. The first technique is to wait for the first 5 minutes of the day before you enter the trade. The downside is you might miss some profits at the beginning of the day. The second, and less risky entry technique, is to wait for 5–10 minutes from the open to buy near 3 before you make a purchase. If you waited for a new high to buy, you would have gotten involved near $15.50, and your risk would have been less than $0.20 per share if your stop was below the low of that day. This is still an excellent entry with limited risk and positive momentum from the onset of the trend. Day 3 and beyond, uptrend. The AVWAP can be used well beyond the second day of a trend. In a stock with strong demand, we may see the pattern of early weakness before trend continuation several days in a row, as shown in chart 8.4. Although the stock did not come down perfectly to the prior day VWAP purple and green arrows, it showed initial weakness on days 2 and 3, which was then resolved shortly after the open. The insets on days 2 and 3 show the initial stock weakness rid the stock of the early profit takers. As the stock climbed above the daily VWAP green circles and buyers had control, this became a purchase opportunity. Red circles mark the price where you place the stop, below the morning low. Short sales with multi-day AVWAPs. Techniques that work for a stock in an uptrend are also relevant to short sales. We will review some examples of stocks that found resistance at or near a prior day's AVWAP when the stock's trend is lower. These stocks then became low-risk, high-probability short sale candidates. Market psychology of the short setup. When a stock experiences a sharp move lower on day 1 and closes near the low of that day, there will likely be sellers in the following day or days. There are also 3 groups of participants in the short sale market: bargain hunters, short sellers, and market makers. Bargain hunters' longs show up in the morning of day 2 with the belief that it is a good idea to buy the stock on sale. These buyers might be eager to add back on the open strength with the thought they missed the low the day before. This increased purchase activity causes the price to go up. In a bout of FOMO, bargain hunters start buying even more, thinking that the stock has reversed course from the previous day's decline. The early strength convinces them that selling was overdone, and it has to go higher, because it is a good company. Short sellers without conviction in their position might get spooked by the early strength and cover their position in order to avoid profit erosion. Market makers who have to sell large quantities of the stock that day will help encourage the bargain hunters and short sellers to chase prices higher by bidding the stock up in the pre-market. For example, if the market maker needed to sell 750,000 shares, they might attempt to create excitement early in the day. They do this by bidding the stock higher in the morning. The market maker may purchase 10,000 or more shares in the morning to drive the price higher so they can sell as many shares as possible at the higher morning prices. When the stock opens higher, that market maker will then sell the 10,000 shares they purchased, and as many additional shares as they can at the more favorable prices to work off the 750,000 share balance they have left to sell. If the market makers can sell 10% of the orders, 75,000 shares, while the stock is above the daily VWAP, they will be thrilled because they know that the balance of their sell order will probably push the stock and the daily VWAP lower as the day progresses. Remember, this is market impact cost, Mike, as discussed in Part 1, Chapter 3. The initial selling gets them a quick start at what is often close to the highest prices of the day. This helps minimize their mic throughout the rest of the day. Day 2, downside price action follow through. If you missed the move lower on day 1 and did not want to short the stock near the first day close, your opportunity comes in the morning of day 2. If the stock opens higher than the previous day close, you want to be ready to sell the stock short under the following conditions. How it unfolds. 1. The stock holds below the prior day's VWAP, see chart below. This shows sellers still have control from the start of the day the move began. 2. After early morning strength, the stock stabilizes below the 2-day AVWAP and price drops below the daily VWAP. This tells us the sellers have regained control of the trend for the new day, and it is then their game to lose. 3. We sell the stock short as it drops back below the daily VWAP and place our stop above the high of the morning. 4. If our stop doesn't trigger, we hold the stock and lower our stop to just above the most recent and relevant lower high for the time frame we intend to hold the trade. Short-term entry tactics like this can be used to establish a position in the stock which might be held for a day trade, or even a longer-term investment. Charts 8.5, 8.6, and 8.7 show some examples of how we can use this information to identify low-risk or high-probability entries into short positions. Chart 8.5 is an example of a stock which experienced strong selling on day 1, where it dropped from $61 to a low of $57. The next day, the stock opened higher, initially looking like buyers might gain back control. Once it dropped below the blue AVWAP from day 1 and the purple daily VWAP green circle, it was clear the sellers were back in control. For those who resisted FOMO buys and kept their focus on price action, the cross back below those 2 AVWAPs marked an excellent short sale opportunity. As always, once in the stock, the stop would go above the most recent and relevant lower high, which was above the morning high at $59.50. As the stock continued lower through the day, it would be prudent to cover part of the position profitably to reduce the overall risk and lower the stop on the balance to a level appropriate to the anticipated hold time. Sell green to red. Notice the day 2 entry technique will get you in the stock ahead of the momentum buyers who like to sell short a green to red move. Many market participants like to sell short at the point stocks go from positive at the start of the day green to negative on the day red. When we short, as the stock crosses below the daily VWAP, it can get us into the stock well before the net change traders. Chart 8.6 shows a less than perfect example to demonstrate some of the nuances of the setup. As I've often said, if you only look for the cookie-cutter entries, you will miss many nuanced opportunities for accurate entries into long and short positions. Chart 8.6 shows day 1 with a lot of volatility near the open. If you waited to enter the trade as the stock dropped below the day 1 VWAP, you would have been able to participate in the initial weakness with a stop above the first lower high shown B and then lower the stop accordingly. On day 2, there were 3 possible short entry points represented by the green dots. 1. As the stock dropped below the daily VWAP purple. 2. As the stock dropped below the 2-day AVWAP blue. 3. As the stock went green to red, opened higher in green and became red with the net negative change. Day 3 and beyond downtrend. In a stock with strong supply, we may see the pattern of early strength before trend continuation several days in a row. Like in chart 8.7, there will be times when a stock in a strong downtrend finds supply at the previous day's AVWAPs. The stock in chart 8.7 gapped lower on day 1A and initially found support at the VWAP green arrows. Later in the day, the stock dropped below the VWAP blue, and that VWAP then became resistance red arrows, and the stock closed near the low of the day. On day 2, the stock gapped up B and showed some initial volatility, and then dropped below both the daily purple VWAP and the blue AVWAP from day 1. The green dot on day 2 shows an excellent short sale location with a stop above the morning high red arrows. On day 3, the stock gapped higher again, C, and ran right into the AVWAP from day 1 blue. That marked the high of the day. After about 10 minutes, the stock dropped back below the new 2-day purple AVWAP and the daily black VWAP. A short sale here, green dot, took advantage of the failure of the early strength and then benefited from strong selling pressure. It is always a good idea to cover part of the position when the stock experiences a quick sell-off, and then lower your stops on the balance to a level that doesn't allow the position to turn to a loss. Risk management. When a stock makes a strong move on day 1, it can be tempting to get involved in the trade at the start of trading the next morning. Rather than jump in with no strategy and hope the trend will continue, we use the day 2 AVWAP in conjunction with the daily VWAP to identify the lowest risk entry for trend continuation. A disciplined approach like this allows us to get involved in the trade at the lowest risk point. Because we enter the trade at the start of new momentum, we also reduce the risk of tying up our capital in a stock as we wait for it to move. Also, this approach gives us greater profit potential. Key takeaways. The previous or several days AVWAP is an important reference level for stocks that experienced a momentum move. The more accurate the entry, regardless of the planned hold time, the tighter you can set your stop, and the more time you have with momentum in your favor. This strategy will help you catch more winners that have broken out or down at the beginning of a multi-day momentum campaign. Whether you use this technique for a day trade, multi-day, or longer hold, it can help you enter a trend at the lowest risk point possible. Day 2 and 3 AVWAP entries provide an advantage over net price change traders, red to green buyers and green to red sellers. Because we enter the trade at the start of new momentum, we also reduce the risk of tying up our capital in a stock as we wait for it to move. Also, this approach gives us greater profit potential. Chapter 9. AVWAP Gap Trading. In a time of rapid change, standing still is the most dangerous course of action. Brian Tracy. Chapter Objectives. 1. Identify and understand the 4 different types of gaps. 2. Avoid chasing a stock that gaps. 3. Disciplined strategies for trading stocks that gap. A gap represents a sudden shift in a stock's valuation that leaves an area on the chart without any trade activity. They are easily seen when successive candles do not touch or overlap. A gap is a simple representation of a rapid shift in the supply and demand dynamics for the stock. A gap higher, bullish, occurs when the price opens above the high of the prior day. A gap lower, bearish, occurs when the price opens below the close of the prior day. See chart 9.1 for examples of bullish and bearish gaps. 4 types of gaps. All price gaps are not the same. There are different classifications of gaps. This chapter will discuss why gaps are important to recognize and understand, as well as specific AVWAP strategies to trade them. There are 4 commonly accepted gap classifications: common, breakaway, continuation, and exhaustion. Common gaps. A common gap occurs regularly in a stock because of normal trade imbalances from day to day. Minor news, such as an analyst's upgrade or downgrade, may cause a common gap, or it could just be a buyer or seller who is motivated by factors known only to them. Common gaps do not lead to longer-term trend shifts. Common gaps are typically filled or closed when trades occur in the prior gap range. Common gaps typically take no longer than a few days to fill. Chart 9.2 shows common gaps higher and lower. In Chart 9.2, the blue circles represent the common gaps. The highlighted area shows how the smaller first gap 1 filled almost immediately, while gap 2 filled the next day, blue arrow. Gaps 3 and 6 did not get filled for the time shown on this chart. Most common gaps get filled. Common gaps offer excellent short-term trade opportunities, especially in a stock where there is an existing Stage 2 uptrend or Stage 4 downtrend. See the market structure chart in Appendix A. For stocks stuck in Stage 1 accumulation or Stage 3 distribution, there is typically no edge to trade a common gap. Chase the gap or wait for AVWAP. In 2008, I wrote one of my first articles about the AVWAP, chase the gap or wait for VWAP. Over the last 2 decades, the strategy outlined in that article has served me well, and I still use it today. The article laid out techniques to trade stocks with a common gap. This strategy provides a low-risk entry into a stock which has experienced a gap. When a stock gap is higher, we are told there are 2 choices: buy the open strength and hope it holds, or buy as the stock pulls back from the gap strength. A third option, wait for the AVWAP, is the technique we explore by using a 1-minute time frame. Keep in mind, the same concepts apply to the longer time frames with the AVWAP from the gap. To trade a common gap successfully, we need to consult shorter, intraday time frames. Chart 9.3 is constructed of 1-minute candles. The green highlighted area shows the gap higher from the previous day, close near $99 per share, up to an open price of $102.75. Anyone who purchased the stock at the open of the first few minutes of the day had to choose between 2 options. First option is to hold the stock as it plummeted back down to $99 in the first few minutes, or to stand aside, let the stock settle down and wait for evidence the buyers were back in control before getting involved. The second option was to wait for the stock to rally back above the daily VWAP 1. This is where the buyers were back in control of the stock for the day. A purchase at this point would put you in the stock after the shakeout. If the move was to fail after entry, a stop under the low of the day, would limit any loss. A stop would go under 2 because it is the most recent and relevant higher low. The stock continued higher throughout the day, and the VWAP found buyers on a quick test later in the day, 3. It is up to the trader to decide if the stock is worth holding for more than a day trade. This decision would depend on the trend of longer time frames, the condition of the overall market, and personal risk tolerance levels. My preference is to take partial profits and let the winner run. In chart 9.4, we see the opposite. A stock which gapped lower, rallied for about 45 minutes, and then broke below the VWAP of the day. Chart 9.4 is a 1-minute chart of a stock which closed on day 1 at approximately $105.30, 1. The stock gapped lower, blue highlight, to open at about $104.60 on day 2. If you had shorted this stock at the open, you would have shorted near the low of the first hour of the day, $103.90, It was worse for the person who shorted at the open, because the stock went positive on the day for a few minutes, and that might have caused them to panic and cover the short at a loss. Rather than short the open, it makes more sense to see if the buyers fail to take control, and then short the stock once the stock drops back below the daily VWAP, 4. When you avoid the initial choppy action in the stock, you are more likely to enter the trade at the correct time, with a logical place for your stop being above the high of the day, 3. A good entry goes a long way in the ability to hold the stock for longer time frames. Of course, there will be times when the stock gaps higher and continues to rally straight up through the course of the day, or gaps lower and continues to sell off for the day. No trade method will get you into 100% of the winners. That should not be your goal. The goal is to find the low-risk, high-probability trades, and a large part of that comes from the confidence in your approach. As it is said, it is better to be on the sidelines in cash, wishing you were in, than it is to be in the market wishing you were out. Gap AVWAP several days. Sometimes a stock will experience a large gap when it might take a few days for the market to digest the gains or losses before the primary trend resumes. People who get excited about the news will chase the stock on the open and pay higher than necessary, as seen in chart 9.5. On the first day, the stock gapped from $29.60 to $30.40, blue highlight. We anchor our VWAP to the first candle of the day, 1. See inset for detail. At 2, the stock cleared the AVWAP, and it would make sense to purchase the stock at $30.30 with a stop below the low of the day, 3. After a quick surge up to $32.50, the stock experienced some profit taking. found enough demand at the VWAP 4 to provide support for the next leg higher. The stock finished near the high of the day. If you missed the entry on day 1, the stock gapped higher again on day 2, blue highlight, and you should set your VWAP anchor to the first candle of the day 5. After a couple of minutes below the purple AVWAP, the stock crossed back up through the VWAP 6. A purchase 6 would have made sense with a stop below the low of the day 7. As we know, all trades will not be winners, and this trade would have been stopped out with a small loss. About 10 minutes later, the stock crossed back up through the VWAP 9. It can be a frustrating experience when it crosses back above the AVWAP so soon after a small loss. The taste of the prior loss might have prevented you from a logical new entry 9. If you stuck to your strategy, you would purchase the stock again and set the new stop under the new low of the day 8. This buy turned into a nice winner as it rallied from the purchase price of $34 up as high as $38 later that day. After it hit the high of $38, it pulled back to the VWAP 10 and briefly bounced before it made a lower high and broke below the VWAP 11. If you used this level as a stop, it would have resulted in a sale at $36.25, a day trade gain of $2.25 or 6.7%. If you held the stock from the day 1 purchase price of $30.30 too, you would be in a stronger position and might have trailed your stop up under the blue AVWAP from day 1. This would have kept you in the stock with a stop near $35 at the end of day 2. Another alternative would have been to allow the initial volatility of day 2 to settle down and then raise your stop on half the position to under the day 2 VWAP purple and the balance below the blue AVWAP from day 1. With this strategy, you would have sold half the stock from the purchase of $30.30 at $36.25 11, and to continue to hold the balance with a stop under the day 1 blue AVWAP at $35. There is never one best way to set stops, only a best way for your risk tolerance and your expected hold time. Breakaway gaps. A breakaway gap occurs when a stock breaks free of a longer-term consolidation, stage 1, accumulation, or 3, distribution, usually with a large increase in volume. The breakaway gap acts as an ignition to momentum that can last months to years. An intermediate to longer-term trader or investor will want to learn to recognize a breakaway gap because of the longer-term implications for the stock. When breakaway gaps occur with a news catalyst, such as an earnings surprise, it is more likely the stock will continue to trend in the gap's direction than it is to fail. If the news that motivated the gap is unexpected and meaningful, it is more likely to lead to a sustained trend. Upside breakaway gaps. Chart 9.6 shows a breakaway gap that led to a longer-term trend. The large gap 1 showed a group of motivated buyers. We anchor our AVWAP to that point. A few days after the initial gap, the stock briefly pulled back and found buyers 2 at the AVWAP anchored from the gap. The support at the AVWAP showed a strong appetite for the stock, and a purchase 3 made sense because it made a higher high after the AVWAP was tested, with a stop below the pullback low 2 because it was the most recent and relevant higher low. As the stock continued higher, it wasn't until 15 months after the initial gap that the stock undercut the AVWAP 4. A holder from the purchase 2, until it broke below the AVWAP 4, recognized a profit of approximately 33%, $20.50 to $27.50. Stops will never get you out at the high, but they will get you out when the supply and demand equation from the original catalyst changes. It is unusual for breakaway gaps to be filled because they represent a powerful shock to the supply and demand equation. The news motivator and increased volume confirm a large and immediate interest by institutions who compete to put large amounts of money to work in the stock at the same time. Many times, people who learned all gaps get filled will wait for a purchase at a lower price, which never happens. This group will often become buyers later in the cycle when they can no longer stand aside and watch it continue to go higher without them. Become FOMO buyers, often at the worst times when prices are far from the start of the move. The strongest stocks will continue higher for several days or longer before they experience a price or time correction. In these cases, if you do not buy on the first day of the move, you may miss out on the initial powerful surge. If you miss the initial move, there are often, but not always, better opportunities to buy the stock on strength after a pullback. It might take a couple days of back-and-forth action around the AVWAP before buyers regain control. A reclaiming of the AVWAP doesn't always lead to immediate continuation. If your stop does not get triggered, be patient and trust your stop. Allow the market to prove itself. Take comfort in a trend once established is more likely to continue than reverse. The stock in chart 9.7 shows how it took a couple of days to absorb selling from profit takers before the stock continued higher. The blue shaded area shows the large gap from $18.65 to $22 per share, a gap of 18%. Clearly, there was a catalyst that got participants excited about owning the stock. We anchor the AVWAP from the first candle of the gap, A. The buyers on the open were quickly overwhelmed by owners who wanted to lock in their large overnight gains, and the stock continued lower over the next couple of days. At 1, the stock rallied up to the AVWAP from the gap and got rejected. Buyers took control too, as the stock cleared the AVWAP from the gap. A purchase at that point made sense with a stop under any of the lows 3, 4, or 5, depending on personal preferences and risk tolerance. As with all trading, there's no right circumstance for every trader. I will often use a tighter stop or sometimes stagger my stops. A staggered stop approach might be to use stops on 1/3 of the position under each of those lows. Points 6 and 7 show how the buyers kept the price above the gap and prevented the price from breaking the AVWAP the next day. This type of action would encourage me to keep my stop under 3. If the stock failed to hold the AVWAP, my concern would be it gives up the entire gain. Once the stock was back above $22 per share, stops might be raised up under 7, downside breakaway gaps. A breakaway gap which starts or accelerates a downtrend is a sign of significant trouble and shows lower expectations for the stock in the future. If you find yourself in the unfortunate position of owning one of these stocks, it is usually best to cut the loss quickly and move on. It is better to accept the loss and discomfort right away rather than wait for more serious price weakness to set in. The stock is not a bargain on sale. It is a broken stock, and if they don't scare you out with the initial gap lower, they will often wear you out, as the stock will need a lot of time to heal before it heads higher again. In chart 9.8, we see an example of a downside breakaway. Stock experienced a large gap lower after an earnings report. We set the initial anchor to the first day of the gap, 1. As we learned from using shorter time frames, the stock will often trade for a few bars, in this case days, below the AVWAP, before a brief rally above the AVWAP 2. This rally would have put the short sellers, who sold during the first couple of days, in a position of losses. They may have covered their positions and missed out on the larger move lower. It wasn't until about 15 days after the initial gap that the sellers regained control of the stock 3, as the stock broke back below the AVWAP from the gap. A short sale there would have made sense with a stop above the high from the gap, 4, or above the high of the consolidation of the prior 6 days shown, 5. This stock continued to show weakness over the following months, and the next quarter earnings report motivated a fresh round of fearful sales, 6. Chart 9.9 shows another example of a downside gap, in this case on a 15-minute time frame. Here, 9.9 is a bearish example of a breakaway gap. The blue shaded area shows the gap from $33 down to $28, approximately 15%. When the stock gaps lower, we anchor our AVWAP to the start of trading after the gap 1. The stock continued down as low as $25.50 that day, which put the dip buyers in a losing position with no reasonable place to set their stop. People who shorted the stock seemed to have a good trade for the first day, but on the second day, buyers gained control as the stock made it back up through the AVWAP 2. Later that day, and into the next day, buyers defended the stock and bought pullbacks to the gap AVWAP 3, 4, and 5. It took a couple of days to digest the news before the stock continued lower. At 6, the sellers took back control of the stock from the gap as the stock broke below the gap AVWAP. This was the correct place to short the stock because price evidence told us the sellers were in control again. Of course, we did not know the stock would continue lower, so we had to set a stop to protect against a reversal. The lower highs we could use to place our stop above are 7, 8, and 9. Just as in the previous long example, we could have used a staggered stop approach. As the stock continued lower, the job was to manage the stops above the most recent and relevant lower highs. From there, the rest is up to the market. Continuation gaps. A continuation gap is also known as a running or measuring gap. We find these gaps in stocks where there is an established trend that likely began with a breakaway gap. Because the trend already exists, these gaps represent a continuation and often an acceleration of the trend. It is common for earnings reports to be the catalyst for these gaps. Like the breakaway gap, the continuation gap is not always filled. It will frequently leave behind those who wait for the gap to be filled. Charts that follow will make that clear. The continuation gap offers some of the best opportunities to participate in a trend if you weren't involved with the earlier move. Most long holders of the stock feel good about owning it and don't want to sell shares. This creates tight supply, and with increased demand, these stocks are often in the sweet spot of their trends. During this phase, there is little volatility and short-term pullbacks are bought up quickly. Because these gaps typically occur somewhere near the midpoint of a major trend cycle, continuation gaps are also known as measuring gaps. They are found somewhere near the middle of a full trend cycle. Exhaustion gaps. Exhaustion gaps occur near the end of a major trend. The stock will reverse the direction of the gap and close at the extreme lower end. When a stock that has been in an uptrend and has experienced a large percentage move, the company will often report positive news to cause a gap. Initial reactions to this news motivates the people who have been on the sidelines who have been waiting for a pullback before they get involved to give into FOMO and buy the stock. The people who have owned the stock and enjoyed the large gains see the opportunity to sell their highly appreciated shares to the FOMO buyers. They use the liquidity from the good news to sell large quantities of stock near the highs. Sales into good news that drove the stock higher will catch a lot of participants off guard because the stock sells off on good news. The market discounts the past and trades on future expectations. Those who purchase the stock in anticipation of good news will sell when the news is released. Good news comes out at tops and bad news comes out at bottoms. If you trade off the news, you may find yourself delivering newspapers. The stock in the daily time frame 9.10 shows three distinctive gaps: breakaway, continuation, and exhaustion. The breakaway gap occurred in January at $160. This gap came close to closure but did not get filled. The opportunity to trade this stock came, A, when the stock made it back above the AVWAP from the gap. A stop would have been under the pullback low B. Notice how the AVWAP green from the gap found buyers on the pullbacks at points C and D. 2. The continuation gap 2 occurred at $210 in August. This was a large gap as the market had already experienced a large run, which robbed the market of supply before the gap. There were some short sellers who felt trapped by the higher prices, and they paid even higher prices in order to minimize their losses as the stock climbed higher. After about a week and a half, the stock finally broke below the new AVWAP blue from that gap E as profit takers stepped in. The supply generated by these profit-taking sellers was quickly overwhelmed as demand from new buyers pushed the stock back above the gap AVWAP blue just a couple of weeks later F. This is where it made sense for new positions to be purchased after the shakeout below AVWAP. A stop on the new purchase F would be placed under E. It took almost a month for the stock to find renewed upward momentum G, but it was worth the wait because the stock experienced a major run from that level. This measuring gap is used to give a trader an idea of what would be a reasonable estimate or measure of where to expect the next major activity level. The measuring gap gets its name from the tendency for a rally, which starts at a continuation gap, to match the gains the rally has already shown between the breakaway gap and the continuation gap. Put another way, you can get a good projection of the remaining potential gains between the gap and the next major activity level. In this chart, the breakaway gap ran 50 points from $160 to $210, so a minimum upside target starting at the continuation gap at $210 is $260, $210 plus $50. This stock clearly exceeded that level and shows why it is best to trail stops up under higher lows for an exit than it is to exit at a price target. 3. The exhaustion gap. This gap occurred in January of the following year at approximately $355. We never know if a gap is the exhaustion gap until after the fact, when the stock cannot continue higher. Yet there are clues that tell us the long run-up from $160 is in jeopardy of tapering off. Unlike the breakaway gap, the exhaustion gap on this chart immediately reversed course H after the gap higher. At H, there were sellers waiting for an opportunity to sell, and the gap higher turned out to be their opportunity to do so. After a week of downward pressure, the stock stabilized above the AVWAP purple I and went to make a new high J. After that high failed to hold, the stock made no upward progress for the next couple of months. The stock was exhausted and needed to rest. In chart 9.11, we see the same three distinctive gaps on a daily time frame, this time with a stock in a downtrend. 1. The breakaway gap occurred at $1,200, and it continued lower for 4 days before it reclaimed the AVWAP red. When the stock dropped below the gap AVWAP A, the sellers were back in control, and it made sense to sell the stock short with a stop above B. This would have been a difficult position to hold as the price crossed back and forth above the AVWAP, and C, it broke above the previous high it had made approximately 2 weeks earlier. 2. The continuation gap occurred at $910. After a couple of days of trades above the gap AVWAP red, it broke lower D and remained below that AVWAP blue through the end of the chart. The AVWAP blue from the gap was not tested from underneath, which showed how motivated the sellers were. Using the measuring technique for this gap, we would come up with a minimum downside target of $620. This target is achieved by subtracting the continuation gap level of $910 from the breakaway gap level of $1,200, which is $290. We then subtract $290 from $910. $910, $290 equals $620. Clearly, this measurement is only a guideline since the stock touched the $620 level about a month after the gap, and it continued lower. We want to have an approximation measurement gap of where the stock could go, but stop losses that trail down above the most recent and significant lower highs will keep you in the trade longer. 3. The exhaustion gap occurred at $430 after a large drop and prices continued to decline. Do not look at exhaustion gaps as a reason to trade against the primary trend. Instead, an exhaustion gap can mean the beginning of a stage 1 accumulation. The stock is just exhausted and needs time to heal. This is mentioned because many people try unsuccessfully to trade against the trend in an attempt to buy the stock at the low. Psychology, don't focus on labels. Too many people get hung up on labeling the type of gap that occurred. The right way to think about gaps is to recognize what they represent in terms of a sudden supply and demand shift rather than label them. Sometimes you will think a gap might be an exhaustive gap when it turns out to be a second or third continuation gap. The important thing to recognize is the opportunity the gaps present for trend continuation or reversal and trade them appropriately. There is no more objective tool than AVWAP from the gap to measure if buyers or sellers are in control. Risk management, gap anomalies. There are some equities and ETFs that experience gaps nearly every day. Thinly traded stocks, little trade volume, are prone to daily common gaps. Stocks that trade American depository receipts, ADRs, gap nearly every day because they must open at the same price in the United States that they trade on their primary overseas exchange. Commodity-related ETFs such as oil and gold trade a nearly 24-hour market. The price change for the commodity outside of the NYSE hours needs to be adjusted at the 9:30 a.m. NY open. This change results in a gap nearly every day. Because ADRs and commodity ETFs gap nearly every day, it is difficult to manage risk. My preference is to not trade them. There are plenty of other stocks and ETFs where risk management is easier. Chart 9.12 shows the daily gaps in an ETF. As you consider a trade setup, take a closer look at how frequently the stock gaps and decide if you can reasonably manage risk in the trade. This is part of recognition of the personality of the stock and if it makes sense for you to trade. Commodity-related ETFs gap nearly every day because the commodities they represent are traded nearly 24 hours per day. Is it really a gap? Most of the time, when a stock gaps higher or lower at the start of trading, it does not represent the first trades of the day for the stock. Stocks that report news outside of regular trading hours, RTH, will begin to trade the moment the news is announced in the pre- or post-market trading hours. The extended hours, or A, of pre- and post-market trade availability differ between brokerage firms. If it is important to you to trade extended hours, find a reputable brokerage firm with the longest hours available to trade. Always be sure to check a chart, which includes pre- or post-market trade data, when you trade a stock with a gap. If the stock was unusually active in the extended hours, it is helpful to anchor a AVWAP from the start of the extended hours trades. When you use the extended hours AVWAP along with the regular trading hours AVWAP, this combination is helpful to find key levels for the stock. This type of analysis applies mainly to day trades. Charts in 9.13 show the same stock with extended hours, A, on the left and regular trading hours, RTH on right. On the left, you can see that trades occurred at all the levels in between the gap level and even well above the high of the RTH trades. On the right, there is a clear gap from the close of day 1 to the opening of day 2. I usually only reference the extended hours trades if the stock traded unusual volume during extended hours. Futures versus ETFs. Like the RTH for equities, major ETFs like the SP 500 ETF, SPY, also trade in the overnight on session of the SP 500 futures. On days when the SPY opens with a large gap, it's helpful to study the AVWAP from the start of the overnight session for the futures. There will often be important levels where the futures market may find buyers and sellers at the on-AVWAP, but the level may not be visible on the RTH SPY because there is not as much price memory from the start of the RTH. The relationship between the SPY and SP 500 futures is important if you trade either of those markets on a short-term basis. Dividends. When a cash or stock dividend is paid to shareholders, the amount of the dividend is removed from the share price. If a stock closes the day at $33 per share, and the next day the company pays their shareholders a dividend of $0.50 per share, the price of the stock is adjusted lower by $0.50 per share. Stock price adjustment is reflected with the share price opening at $32.50, assuming there are no other supply and demand imbalances that impact the opening price. The lower open for this stock will cause a gap on the chart. These gaps are not due to an ordinary imbalance in supply and demand, so I do not consider these worthy as a trade candidate on the day of the dividend. What about fading the gap? When people fade the gap, it simply means they want to take a position on the other side of the trend or direction of a gap. They want to short a stock that gaps higher or buy a stock that gaps lower. The focus of this book is to trade with the trend, to buy stocks in uptrends, sell short stocks in downtrends, and avoid the neutral time stages 1 and 3. You always want to give a trend the benefit of doubt that it will continue for a longer time frame. When a stock in an uptrend gaps lower, they can be great buy candidates. Stay focused on the trades in relation to the daily VWAP as well as the important AVWAPs from longer time frames. Gaps occur in all stocks at some point, so it is important to be prepared with an objective approach to handle them. Risk management, placing stops. Perhaps the most difficult part of any trade is the management of the stops while the trade is working in your favor. In the examples, I have outlined several scenarios for how to go about placing and updating stops. As with everything in the market, only hindsight is 20/20. To compensate for the risk of the unknown, my preference is to use several stops. The first one is the tightest, meaning smallest dollar increment because it protects the initial capital. How tight you set the stop depends on your personal risk tolerances. I set the second stop after the stock has moved in my favor. I set the second stop tightly enough that I can lock in some gains if the stock reverses, which lowers the overall risk. I set the third stop to give the stock a little more room to breathe. This hopefully prevents getting stopped out before it turns into a larger winner. Key takeaways. Gaps occur on a regular basis. Without a strategy, we are prone to FOMO trades. No trade method will get you into 100% of the winners. That should not be your goal. The goal is to find the low-risk, high-probability trades, and a large part of that comes from the confidence in your approach. As it is said, it is better to be on the sidelines in cash, wishing you were in, than it is to be in the market wishing you were out. Stops will never get you out at the high, but they will get you out when the supply and demand equation from the original catalyst changes. Day 2 entry techniques allow us to participate in a stock when we might have normally missed the day 1 gap opportunity. Be aware of extended hours trading in gap stocks. Unusual circumstances such as dividends, ETFs, and futures create special gap situations. Chapter 10. The Short Squeeze. The average trader is naturally a chronic bull. It is human nature to prefer optimism to pessimism. Philip Carrot. Chapter Objectives. 1. Understand short interest and the short interest ratio. 2. Identify the price levels and trends of where short sellers are involved. 3. Understand why short squeezes occur. 4. Identify two types of short squeezes, knee-jerk and structural. The appeal of selling short is easy to understand because stocks can drop much faster than they rise. There are unique risks involved when you sell a stock short. The biggest risk to a short seller is that the stock price rises instead of drops. Rising price in a heavily shorted stock can lead to dramatic upward price movement, as losses mount in the accounts of those who are short. The short sellers magnify the upward price movement as they buy the stock to try to minimize their losses. This can lead to dramatic upside price moves where trend traders can profit. This momentum creates a double demand, new long purchases and shorts covering for a stock when there is not much supply offered. Additionally, supply is often tight for a stock in a strong uptrend as holders want to hold their profitable position. When the stock rises rapidly, the shorts lose money, and as they try to cover their bearish bets, they compete for supply from new longs. Because there is extra competition to buy the stock, the shorts feel pressure from mounting losses and they become squeezed. Before we explore the dynamics of a short squeeze, let's cover some terminology and learn how to interpret short sale data. Short interest. Short interest refers to the number of shares sold short and not covered bought back. Because these shares are still open short positions, they represent a source of future demand. Short sellers either buy the stock at lower prices to lock in gains, or they buy at higher prices to minimize losses. It is useful to know when a stock is sold short. Exchanges mandate that brokerage firms accurately keep and report the numbers of shares sold short and not yet covered. Twice each month, the firms tally all short sales and send the data to the various exchanges. Exchanges then combine the firm's data and publicly disseminate the information. FINRA releases the number of shares sold short twice per month. The number reported to the public is never the real-time number. In fact, it is a minimum of 2 weeks old. For instance, the total number of shares for stocks as of January 15, in the table below, is reported to FINRA by January 20 and is released as public information on January 27. That means the stocks continued to trade for a full 7 business days or longer before FINRA releases the information to the public. As we will see, the information is still useful to determine the trend of short sales and the price levels where the short sellers are involved. Short interest ratio or days to cover. The short interest ratio, SIR, or days to cover, is the number of shares sold short interest for an individual stock, divided by its average daily trading volume over the previous 2 weeks. We interpret the SIR as the number of days it would theoretically take to buy back the shares that were sold short based on the average daily volume. I use the term theoretically because the shorts are not the only participants in the market. Table 10.2 shows the number of shares sold short was 13,918,435. At the time of the report, the average daily volume for this stock was 2,047,326. When we divide the short interest by the average daily volume, we get the number known as days to cover, DTC. We also refer to this as short interest ratio, SIR. In this example, the SIR equals 6.8. This means that if the shorts wanted to cover their position in full, it would take them just under 7 days if they were the only volume in the market. Of course, it would actually take a lot longer to buy all that stock back since other traders are also actively buying or selling the stock. The higher the SIR is, the more difficult it is to exit a short position and the greater the upward impact will be on price. I consider an SIR of 5 or greater to be significant enough to think a short squeeze could develop in the stock. The effect of volume on SIR. If a stock had a short position of 4,800,000 shares and an average daily volume of 800,000, the SIR would be 6.0. This means it would take 6 full days of average daily volume for the short sellers to cover their bearish bets. If the same stock traded an average of 2.4 million shares per day, the short interest for the stock would be 2.0, or 2 days to repurchase. Using the same stock, but with an average daily volume of just 200,000 shares, the SIR would then be 24, meaning it would take 24 days of buying to cover the positions. When their short position is at a loss and the stock has strong upward momentum, the short sellers feel trapped in their losing position. They know their buying will add to the upward momentum. From a trapped short standpoint, the lower the SIR, the better, as their buys will not have as large of an impact on price. When analyzing an opportunity to make a trade that takes advantage of a potential short squeeze candidate, a higher SIR is desirable as it is more difficult for the trapped short sellers to cover their positions. The buys they need to make to cover their short positions have the potential to create significant upside momentum as more and more short sellers compete to close out their losing trades. You may see differences in the reported SIR from various data sources. The discrepancy occurs if the average daily volume used in the calculation is not from the last 2 weeks. Some data providers use a 50-day average of volume rather than the average of the last 2 weeks. It is important to note that a large outstanding short position or short interest ratio by itself is not a reason to buy a stock in anticipation of a short squeeze. It is an excellent gauge of potential demand for a stock, which should be a part of every trader's arsenal. Short sellers are often correct. Short sellers with large positions against a stock are typically sophisticated speculators who have done extensive research on their targeted company. They are often correct, and they make large profits as the stock declines. There are also those short sellers who have the right idea based on their fundamental analysis, but the timing of their short sales is off. That can lead to their positions being squeezed. When short trades are correct about a trend, they will add to their positions as seen in Chart 10.3. The stock in Chart 10.3 was in a steady downtrend red arrow, and the short interest continued to rise green arrow as the prices fell. The short sellers were emboldened by the lower prices and added to their bearish bets as the stock price dropped. Short interest trend. When we look at the changes in SIR during reporting periods, we can spot the trend of the short sellers and then recognize the value of the information. In Table 10.4, you can see that in late May, there were only 225,000 shares sold short in this stock 1, but it had jumped to 13.9 million shares by January 15, 2. That means the shorts added 13.7 million shares to their short position in 6 months. The average daily volume increased from 746,000 to 2 million, and the SIR climbed from less than 1 to 6.8 days. The information in this table is used in Chart 10.5. Now we know when the short sellers became more aggressive. Next, we want to know at what price they shorted. If they shorted at prices higher than the current price, they would not feel pressure to buy back because they are in a profitable position. When the average short position is initiated at lower prices than the current price, the short sellers are in a losing position, which makes them vulnerable to a squeeze. Chart 10.5 below shows how rising prices motivates short sellers to cover their positions. As we see in Chart 10.5, the short position increased from 2.0 million shares to 13.9 million shares from the end of September to January 15. The AVWAP from 0.36 to 0.06 was about $13.01. We can assume this is the approximate price most of the short positions were initiated. When the stock broke past the range A, it closed near $20 that day. That means the average short at that point was down approximately $7 per share. That's more than a 50% loss overnight. Notice how the number of shares in the short position dropped by 6.2 million shares, from 13.9 million down to 7.7 million shares in the next month. This drop is clear evidence that the short sellers took some large losses, and they remained in a vulnerable position on the balance of the trade as the stock made higher highs and higher lows after that gap higher. Market psychology. When do short squeezes occur? Short squeeze develops when those who sold the stock short, with the expectation it would continue to decline in price, change their minds about their trades and attempt to cover their positions before the stock advances and large losses accumulate. The occurrence of a rapidly rising stock price with a large short interest is known as a short squeeze. The shorts' buys become part of the market impact cost, as their buys negatively affect the position they are in. There are several groups of participants who play a part when a stock gets squeezed: fearful buyers, forced buy-ins, margin calls, target short squeezes, and stock loan calls are some of the ones we explore below. Fearful buyers. If you have ever been short in a stock that continues higher against your position, you understand the fear that higher prices elicit. To eliminate the mounting losses and the emotional trauma of holding a big loser, short buyers may panic with their purchases. These purchases cause the stock to advance at a rapid pace as the pressure of holding a losing position mounts on the short seller, and the short seller gets squeezed. The primary motivation to cover a bearish position as the stock rises is the fear of unlimited losses. When you buy a stock at $30 per share, your maximum loss potential is $30.00 per share. When you sell a stock short at $30, the potential for loss is, in theory, unlimited. Stock may rise to $60, a 100% loss, or it could climb to higher levels resulting in losses of greater than 100%. It is the fear of such an advance that can make for an explosive upside moves in a heavily shorted stock. In Chart 10.6, we see a clear example of shorts covering their position as the stock rises. Chart 10.6 illustrates what a short squeeze should look like. The stock broke past resistance A and then settled in for a few days. Once the stock made it past the AVWAP B from A, the buyers regained control of the trend. The short interest below the price action shows how the upward momentum motivated short sellers to reduce their position from 16.9 million to 11.39 million shares. Short squeezes can occur for many reasons, including news events that change investor perception of the worth of a company. A short squeeze can also develop as long holders of the stock attempt to push the price higher in an attempt to tap into the emotional buying that trapped short sellers often provide. If buyers are in control of the stock, it is in a stage 2 uptrend. They know short sellers are vulnerable. So long holders will often buy extra shares as the stock rises, with the hope the buyers can create enough fear in the short sellers so they buy back their position, resulting in the price moving higher. This can be like pouring gasoline on a fire. It only serves to make it burn hotter and stronger. Forced buy-ins. Sometimes short sellers find themselves in a position of being forced by their brokerage firm to purchase the shares they had sold short to cover their short positions. There are two reasons for forced buy-ins: margin calls and targeted short squeezes. Margin calls. When losses in a short position have gone so far against a customer that the equity levels in their account fall below exchange requirements, the brokerage firm is required by regulatory bodies, the SEC, NAST, as well as others, to demand the customer either to deposit more margin money into their account or buy the shares to close the short position. If the customer does not deposit the additional money, the brokerage will buy the shares to close out the short position and get the customer's account in compliance. Another reason for a forced buy-in of a short position comes when the shares shorted are no longer available to be borrowed against. When long holders of the stock, who have allowed shares to be borrowed for a short position, sell their long position, the short sellers who borrowed those shares will have an illegal naked short position. If this occurs, it is the responsibility of the brokerage firm to demand that short sellers either find other shares to borrow or force customers to buy the stock. If the short seller cannot locate other shares to borrow, the short seller is required by securities regulations to purchase shares, or the brokerage firm will do it for them. The forced buy-ins are not handled with care. The brokerage firm is only concerned with making the buys before the close of business, before the risk is assumed by the firm. This can lead to dramatic upside movement in a heavily shorted stock, targeted short squeezes. There is a more sinister way the short sellers can be squeezed, called a forced buy-in. When large, long holders wish to inflict maximum damage on short sellers, they will allow their stock to be borrowed until a time where the buyers have taken control of the trend. If an institution that is in a long position of a stock, let's say 1 million shares, suddenly demands that the shares they loaned out be delivered back to that firm, the short sellers who borrowed the shares are stuck looking for new shares to borrow. If the short seller cannot locate new shares to borrow, they must purchase the shares they are short. This is effective to place pressure on shorts because of its cold-hearted implementation. In effect, the long holders set the shorts up to be squeezed. No one said Wall Street was a nice place. Stock loan calls. When you purchase shares, you can request that the company issue an actual stock certificate, but this is rare. Most investors purchase stocks in street name, which means that the brokerage firm holds the shares as a convenience to the customer. A source of revenue for brokerage firms is to loan customer shares to be shorted. Depending upon how the investor you purchased shares and set up your brokerage account, you can either allow or not allow a brokerage to loan out your shares to short sellers. If your shares are in a cash account, the brokerage cannot loan your shares. If your shares are in a margin account and therefore with an hypothecate agreement, it allows the brokerage firm to hypothecate, lend out these shares to other customers who may want to establish a short position. The brokerage will charge customers fees to borrow stock for short positions. A way to prevent your long positions from being lent out is to enter a good, until canceled, GTC sell order on the stocks at a price you believe has little chance of being transacted. For instance, if your stock is trading at $30, you enter a GTC sell order at $200. Because of the pending order to liquidate your long position at $200, the brokerage firm cannot lend out the shares in your account. 2 types of short squeezes. People often call any short-term stock bounce in a downtrend a short squeeze. Most quick rallies in a downtrend include short sellers covering their positions during and in part causing the rise. Not all short squeezes lead to a continued upside price increase. Below we examine 2 different types of short squeezes, the short-term knee-jerk squeeze and the longer-term structural short squeeze. Knee-jerk short squeeze. This squeeze occurs in a longer-term downtrend with a large short position. When a stock in an established stage for decline is accompanied by a large short position, short sellers are in control of the trend. Their accumulated profits make short sellers less likely to panic and cover at the first signs of a bounce. When prices are in a stage for decline, short sellers can dig their heels in and stay short until their bearish opinion changes, or in the most severe down market, the stock becomes delisted in a bankruptcy. Still, some short sellers will panic and cover their position after even a small bounce. Chart 10.7 shows a knee-jerk short squeeze. Notice how, after the large gap down in November, short sellers covered some of their shares, which you can see in the declining short interest. As the stock continued lower over the next few months, short sellers became emboldened and nearly doubled their short position, green arrow. While many participants try to buy the dip as a long position, short sellers know there is no such thing as down too much. Therefore, they continue to hold their short position. Stage 4 decline stocks can experience quick and large rallies, but those short-term bursts typically fail as longer-term selling pressure is too strong to overcome. Psychology, trading against the trend. Stocks in a downtrend will attract momentum short sellers who pile on extra shares of short stock after the short-term rallies. You may be tempted to buy the short-term rallies because they can result in quick trading gains. However, when the longer time frame is lower, long purchases are very risky trades. These short-term bounces are best left to the most risk-tolerant traders who specialize in the shortest time frames. The best course of action is to stay with the primary trend rather than fight them. Structural short squeeze. A second short squeeze is what I call a structural short squeeze. It occurs when a stock in an established stage 2 uptrend has a large short position that is out of the money. When we combine the price data along with the short interest trend of the short sellers, we can determine the approximate price level where the short positions were initiated. We use this information to determine the pain point where the short sellers in the aggregate are in a losing position. Once the average short seller is losing money, the stock is vulnerable to a squeeze and a subsequent increase in price. If most short positions were initiated at lower levels, the growing losses in a rising stock motivate short sellers to reconsider their positions and purchase the stock. When they cover their shorts, additional demand fuels the market, which adds further pressure to the average short seller. This type of squeeze setup, chart 10.8, can lead to substantial moves higher. This is based on the large number of short sellers who are wrong about the stock's price decline. The stock in chart 10.8 shows an initial advance from A to B. During that rally from $32 to $52, the short sellers remained stubborn about their view of the stock, as shown by little change in the short position, blue arrow. After the rally began to pull back, we anchor a AVWAP to B. We can see the short sellers remained complacent and even added a few shares to their bearish bets, to 11.7 million short shares. It wasn't until C at $45 per share, when the stock crossed back above the AVWAP from the prior peak B, that we knew for sure the buyers were back in control. At D, short sellers began to cover their positions, red arrow. Over the next few months, the stock rallied from $45 up to $69 per share, and the shorts covered 5.7 million shares. The stock still had 6 million shares of exposure with the stock at all-time highs. I wouldn't want that position. The stock in chart 10.9 shows when the shorts remained stubborn. Focus on B, where the buyers clearly took control of the stock. We knew for certain the buyers were in control from that peak B, where it crossed above the AVWAP anchored from the high A. Short sellers who increased their position from 3.9 million to 12.3 million shares at or near B were in trouble because the stock was above that AVWAP. The interesting part is that the short position was at the highest level, 13.7 million shares, while the stock broke to an all-time high after C. The AVWAP green from the last higher low C was rising under the stock as it traded in a tight range. With buyers clearly in control and short sellers in a large losing position, this is the type of stock you want to identify as a structural short squeeze candidate. Here are some general points to help you determine the stocks that may become structural squeeze candidates. 1. Uptrend on the daily time frame. At a minimum, the stock must be above the rising 50-day moving average. Stocks at or near all-time highs are best because there is no real motivated source of supply from holders looking to get out at break-even, and all of the longs are in a winning position. If the stock is in a downtrend, it is not a good squeeze candidate, as short sellers are in control and have no reason for aggressive purchases. 2. Absence of any hedging vehicles. Some common ways for short sellers to hedge bearish bets are with options, a different class of common stock, warrants, convertibles, preferred stock, or any other hedge products. If there is an inability to hedge against a short exposure, it will leave the short seller in a more vulnerable position. 3. Short interest should be high relative to average volume. The higher the SIR, the greater the difficulty short sellers will have in purchasing their shares. 4. Level of potential squeeze. Check to see the approximate level that most shorts were initiated. We can approximate this with the AVWAP. When the stock rises above this level, the average short seller is losing money. That makes the shorts exposed to a squeeze. Stocks with double sources of demand, longs and shorts, and tight supply, especially if the stock is at or near an all-time high, can lead to excellent upside trade opportunities. Short sellers are usually savvy speculators. However, like any group of market participants, they aren't always right. When shorts are wrong about the direction of a stock, their move to cover can lead to some excellent trend opportunities for traders who can recognize the squeeze situation develop. Key takeaways. Short squeezes are motivated by short sellers who fear unlimited losses that can arise from being in a losing position. The higher the SIR is, the more difficult it is to exit a short position and the greater the upward impact will be on price. I consider an SIR of 5 or greater to be significant enough to think a short squeeze could develop in the stock. Knee-jerk short squeezes are typically short-lived. Structural short squeezes can lead to longer-term uptrends. We want to identify structural short squeeze candidates because they can lead to dramatic upside moves where trend traders can profit. Chapter 11. IPO Trades with the AVWAP. If you know the 0 point, you can measure anything. WD Gann. The IPO is the 0 point for every stock. Brian Shannon. Chapter Objectives. 1. How AVWAP adds objective structure to IPOs. 2. IPO AVWAP is useful from the first minute of trades to years later. A private company first sells shares of stock to the public to raise capital. The process is known as the initial public offering, or IPO. It is referred to as going public because it is the first time the public can own a piece of the company through an offering on a public exchange. It is the birth of a stock. Initial public offerings are a unique opportunity to study price action from the inception of a stock as a publicly traded company. Because there is a defined starting point to anchor an AVWAP from, an IPO offers the purest look at supply and demand from a fixed starting point shared by all participants. Why anchor to the IPO? All IPOs start their life as a public company with a single trade. That first trade is the opening print, where all of the buy and sell orders are matched. After that first print, the stock trades freely in the open market. The opening print is usually the largest volume of stock on a 1-minute time frame. The large volume of the opening print is the aggregate of all the buy and sell orders. After the opening print, the stock trades like any other stock, subject to the laws of supply and demand. The AVWAP has been my primary analysis tool for IPOs since I first began to experiment with it. Chart 11.1 is a blog post from www.alphatrends.net in 2007. For the first couple of weeks, daily chart data is of little value without an AVWAP. If you trade from a chart with daily data, wait for more data to build to make sense of the chart. If you want to use the 50 DMA, you need to wait until the 50th day the stock trades. If you want to trade the first day the stock comes to life, look at intraday charts and use VWAP and AVWAP. Start charting the shortest time frames. I start my analysis of IPOs on the first day with a 1-minute chart. The 1-minute chart allows me to see price action develop in real time. As the stock builds more price and volume data history, my analysis will move out from a 1-minute time frame to 5 minutes, 15, 30, 65 time frames and longer. Of course, it is always by using a multiple time frame analysis where we find the most value. The first trades of an IPO are similar to gap trades. There is a sudden supply and demand shift, which becomes an important anchor point for the stock. There is no subjectivity about where to set the anchor in an IPO. We set it from the first trade. Following examples use several time frames to emphasize how important the IPO AVWAP is from the first trade of a new stock to several years after the IPO. Chart 11.2 is a 1-minute time frame. It begins the moment the stock traded through the end of its first day as a public company. There are two AVWAPs on this chart. The first VWAP purple is anchored to the first minute of trading. The second AVWAP blue is anchored to the second minute of trading. The stock was a hot IPO, which means there was a lot of demand right out of the gate. We know that because the stock immediately rallied so strongly that it triggered an exchange halt 1 after a quick rise of 10%. Stocks are halted by the Nasdaq for a few minutes when a move of 10% or more occurs in a 5-minute period. The AVWAP from the first minute trailed the stock significantly through the end of the day. If you waited for a pullback to the AVWAP from the open, you would have missed the move since it never touched the first minute AVWAP purple. If instead, you knew to anchor from the second minute that does not include all of the volume from the open print, you would have had the opportunity to purchase the stock on 2 occasions, 2 and 3, as the stock tested, and then rallied away from the second minute AVWAP blue. Stops for these buys would be placed below the low at the blue arrows. Graduate to multi-day AVWAPs. Chart 11.3 continues to build on the stock from chart 11.2. This is the same stock as chart 11.2, 2 days after the IPO. This chart is constructed with 5-minute data. The circled area shows how the AVWAP from the IPO found buyers on the day 3 as the stock opened on a gap down. It will surprise you how often buyers or sellers congregate near the IPO AVWAP, even years after the stocks come public. Institutions will often buy on pullbacks to the IPO AVWAP, so we want to be ready to act in that area as well. After day 1 of an IPO, it is no longer necessary to anchor from the second minute as the divisor increases and the impact of the first minute trades lessens. Chart 11.4 shows how the addition of AVWAP from the IPO adds structure to our analysis. The left chart shows the stock with price action only. On the right, we see the AVWAP from the IPO along with price action for the same stock. Notice how the initial rally failed to hold 1. As it made a lower low under the AVWAP, it led to a quick sell-off below 1. 2 days later, the stock rallied to the IPO AVWAP 2. After it moved through the supply in that area, it made a higher high above the AVWAP 3. This would have been a low-risk entry with an initial stop below the most recent and relevant higher low, 4. As the stock rallied past $13 per share, it would be time to raise the stop to under 5. At 6, the stop 5 would have been undercut and stopped out. Of course, someone with a longer-term goal might not have their stop so tight, and more risk-averse traders may have had an even tighter stop. Chart 11.5 shows the AVWAP action for an IPO stock. Here is an example of the first 3 days of trades for an IPO with 10-minute data. We set the anchor to the first candle 1 on the chart. Notice how the buyers scooped up shares of the stock on the week open on the second day 2 and the day after that 3. With the benefit of hindsight, we can see a purchase 2 or 3 would have worked, but the better buys were A, B. These were better buy levels because the stock had upward momentum and a stop could go below the pullback low. A look at the 1-minute chart on the open of day 2 and day 3 would have been the best opportunity to purchase this stock with a second-day entry technique. Longer-term chart timeframes for IPOs. The IPO AVWAP anchored 1 in chart 11.6 was briefly undercut 2 before the stock broke to a new high 3. A purchase 3 would make sense with a stop below the low 2. There are several higher lows discussed below, so the stop should have been raised to protect the gains over the following months. Regardless of where you may choose to set a stop, it would be unforgivable to allow the stock to come all the way down to break-even 4 or worse, to allow it to turn into a loss. Notice how the stock tested and closed above the IPO AVWAP at points 5, 6, 7, 8, and 9. These were all good levels for a stop. The stock broke and closed below the IPO AVWAP 10, 5 months after the stock came public. The stock then held below the AVWAP 11. A short sale would make sense here since the stock reached a lower low below AVWAP. Stop on this short sale would have gone above the most recent and relevant lower high 12. In chart 11.7, we see a stock that was trapped under its IPO AVWAP for months. The stock in chart 11.7 looked like it would be a successful IPO for the first few days, since it opened near the low of the day 1 and closed well above the IPO AVWAP for the first few days. Broke below the IPO AVWAP 2, but recovered 3. At 3, it looked like buyers had control again, but it didn't last long, and the stock broke below 2 and made a lower low 4. This is where we have confirmation that sellers established their dominance 4. Over the next 11 months, the stock rallied up to the IPO AVWAP 5, 6, 7, and 8, and sellers maintained control as the stock failed to close back above the IPO AVWAP. As downward pressure accelerated away from the AVWAP, there were excellent short sale opportunities, A, B, C, with protective stops above the preceding highs, 5, 6, and 7. Chart 11.8 shows how the IPO AVWAP flipped from resistance to support, and then back to resistance. Chart 11.8 is constructed of weekly candles. Some people prefer to look at longer time frames with fewer data points for less noise. With 1 week being 5 days, there are fewer candles to represent the same data. As with all technical analysis, the IPO AVWAP concepts are the same on all timeframes. The anchor is set to the first candle 1 of an IPO, regardless of the time frame. Over the next 3 weeks, the stock remained below AVWAP until 2, where it could have been purchased with a stop under A. As the stock progressed higher, it found buyers on pullbacks to the IPO AVWAP 3 and 4. When the stock moved higher from that level, the stop should be raised to just under 4. It would have been stopped out with a good gain, 5. Next couple of weeks, the stock made a higher low until 6, when it started to trend lower, below the low of the prior low. The break 6 occurred below the IPO AVWAP, so a short sale 7 made sense with a protective stop above the high 6. The IPO AVWAP can be useful 4 years after the stock comes public. Chart 11.9 is constructed of weekly candles, showing nearly 3 years of trades for the stock. We set our anchor to the first week of the IPO 1. After 5 weeks below the IPO AVWAP, the stock was a good buy 2 when it cleared the IPO AVWAP and cleared the prior week high. The stop on this long would be placed A and then raised up under the low of 3, where the stock bounced from the IPO AVWAP. At 4, the long position would be stopped out as the stock made a lower low. A couple of weeks later, the stock broke below the prior week low 5. This would have been a good place to enter a short position with a stop above B. If a trader progressively lowered the stops to just above the lower highs, the short would have been stopped out 6. This is where the stock broke above the IPO AVWAP and above the prior week high. A couple of months later, the stock pulled back and found buyers at the IPO AVWAP 7, which had been set over 2 years prior. At 8, the stock cleared the prior week high after it successfully defended the IPO AVWAP. A purchase 8 made sense with a stop just under the low 7. Historical IPO example: Google Alphabet, Inc. came public in 2004. The daily chart 11.10 shows the first year of trades in the stock. The inset shows greater detail of the first couple weeks of trades. The AVWAP starts on the first day of the IPO 1. On day 7 of trading, see inset, the stock undercut the IPO AVWAP 2, and it would have made sense to be stopped out there since sellers were in control. About 2 weeks later, the stock climbed back above the IPO AVWAP 3. A new long purchase could be made here with a worst-case stop below the low, A. It wasn't until 6 months later that the stock tested the IPO AVWAP 4. For those who didn't already own the stock, it made sense to purchase 5 as it rallied away from the AVWAP. A stop on this purchase and any existing long position would go under the low 4. The stock has been one of the great stocks of all time. Key takeaways. IPOs are obvious anchor points. From the first minute of trades to several years later, the IPO AVWAP proves to be a valuable reference point. Buyers and sellers will make decisions that lead to the formation of support and resistance at the IPO AVWAP. As with other strategies, the IPO AVWAP is not the only valuable anchor point on the stock. Use the knowledge from previous chapters to find the other anchor points that are suitable for your time frame and risk tolerance. If you want to trade a stock on its IPO day, you need to use a VWAP. On the first day of an IPO, anchor an AVWAP at the second minute of trading for objective analysis without the noise of the first-minute opening print trade. In closing, man's mind, stretched to a new idea, never goes back to its original dimension. Oliver Wendell Holmes, Jr. What will you do with this information? It is my hope that you recognize the power and flexibility of the anchored VWAP for innumerable timeframes and setups in the markets. There is no wrong way to use what I've laid out for you. I expect some readers will use the concepts and information to complement and fine-tune an approach that already works for them. Others will try to replicate the strategies exactly as they have been laid out. If so, I ask that you also follow my advice on managing risk aggressively. If you do both of these together, you have a good chance for success. Any approach that works and limits losses when it doesn't work creates the type of mindset that allows you to accept small losses. When armed with a winning strategy, you have the confidence to have an attitude of, I loan dollar back to the market and I will get it back with interest. A short-term loss can be part of the process. Do not get stuck in hindsight analysis. Instead, learn to use past data to anticipate what may be next for a market. This is the best way to create a logical plan that includes the possibility of being wrong and taking a small loss before causing major damage to your account. Remember, the AVWAP is a tool. Like any tool, it can provide great value if used properly, but in the hands of an unskilled practitioner, it may do more harm than good. I hope I have explained it clearly so you are confident in getting started to take your trading to the next level with the help of AVWAP analysis. Now, take your time to become familiar with the AVWAP before you jump into the market guns blazing, looking to make every trade a winner. The cornerstone to any successful approach is risk management. Risk management is always job number one. And remember, the only thing that really matters in the market is price action. Only price pays. If you found this information to be helpful, please leave a review where you purchased the book. Part 3, Appendices. Appendix A, the 4 stages of market structure. All trade strategies should be based on a solid comprehension of market structure. There is a definite cyclical flow of money in and out of assets, and we can observe this rhythm on charts of all time frames. Graphic A1 is a reference to the various stages of a stock's life cycle. For a high-definition, downloadable electronic copy of this, please see page 234. Stage 1 accumulation refers to the period when a stock has no trend, it trades sideways. It occurs after a drop in prices. It is the process of buyers gaining control from sellers. We know it is in stage 1 only after the buyers have regained control of the stock, and it enters a stage 2 uptrend. Until it is in uptrend, it is a trendless market that should be avoided by trend traders. Stage 2 markup uptrend is the bullish phase for stocks or markets. The markup stage is an uptrend, as defined by higher highs and higher lows. This is the time to be long. Stocks in uptrends are considered to be innocent until proven guilty. Stage 3 distribution. After a prolonged advance, sellers will start to overwhelm the buyers. This causes the stock or market to turn sideways. We know that it is stage 3 only after a decline has begun. Until the decline begins, it is just a neutral period that should be avoided by trend traders. Stage 4 decline downtrend is the bearish phase of a stock's life. This is when to be on the lookout for short sale opportunities. The decline stage is defined by lower lows and lower highs. Stocks in downtrends are considered guilty until proven innocent. To summarize, we want to avoid sideways neutral periods, stage 1 accumulation and stage 3 distribution. Go long in markets where the trend is higher, stage 2 markup uptrend. Short or avoid markets where the trend is lower, stage 4 decline downtrend. Trend formation. The direction of the expansions and contractions forms trends on a chart. A move in the trend's direction on a higher, longer-term time frame is referred to as an impulse wave. In the short term, countertrend moves are called a pullback 1. The rally high is called the swing high, and the pullback low is known as the swing low. The trend's legs or thrusts will see an expansion of the range higher, followed by a contraction of the range in the corrective leg. These are shown in charts a 2 and a 3, trade with the trend. When a stock has higher highs HH and higher lows HL, it is in an uptrend. Only in retrospect, after prices pull back from each peak, can we identify the HH. Chart A2 shows 3 higher thrusts, represented by the green arrows. The red arrows show the corrective waves or pullbacks. Keep in mind, a pullback only occurs in a primary uptrend. Stocks in downtrends are considered guilty until proven innocent and should be avoided by long traders. The very definition of a trend is what gives us the most compelling reason to be trend traders. An uptrend is marked by a series of HHs and HLs. This means the sum of the rallies will be greater than the sum of the declines. Therefore, the best odds for profitability lie in trading in the direction of the primary trend. Note, the last HL on chart A2 has a question mark next to it. As the trend changes to a corrective mode, we do not know if it will be a HL or if it will fail outright and reverse the trend. Just like support and resistance, we know only after the fact if it will be a higher low, so we wait for evidence of a turn back higher before we consider a purchase. If the stock does turn back up, the most recent low is known as the swing low. Regardless of the time frame, from years using the weekly chart down to just one day using a 1-minute chart, the behavior of a stock in an uptrend is the same. The uptrend action looks like a staircase, with prior levels of resistance that act as support for price. The opposite is also true for downtrends that are defined by a series of lower highs and lower lows. Chart A3 illustrates how, in a downtrend, the sum of the declines will be greater than the sum of the rallies. Price and time corrections. Markets alternate between periods of price advancement in an uptrend and price contraction as it consolidates the decline in a downtrend. The expansion of the price range uses up a lot of energy, and the market needs to rest. The rest period can occur by a price pullback or a sideways correction through time. A time correction is a stronger candidate for a trend to continue higher than a price correction. The lack of a deeper price pullback in a time correction indicates a continued strong bid for shares. A deeper price correction shows a less aggressive bid for the stock. Regardless of how a correction occurs, it is a chance for the stock to rebuild energy and accept or reject new prices. It is considered more bullish when a stock corrects through time, as shown in chart A4 with the green shaded areas, than a price pullback, indicated by the red arrows. A price correction is still bullish as long as a HL is formed. Both time and price corrections should be monitored for evidence of buyers regaining control, so we can make a low-risk purchase in the direction of the primary trend. The opposite action unfolds for a stock in a downtrend, as seen in chart A5. On chart A5, time corrections in a downtrend, red shaded areas, are considered vulnerable because they show a lack of aggressive demand. Weak bidders for the stock are eventually overwhelmed, and the stock continues lower. The price correction's green arrows are short-term rallies which end up in failure as the longer-term downtrend prevails. It may be tempting to buy stocks at perceived bargain prices. It has been a popular mantra to buy the dip, but as we have seen in Part 2, Chapter 7, buying dips is a flawed strategy. Selling the rip is another popular phrase amongst market participants who sell short the strength of a stock. If you have ever acted on this kind of advice, I'm glad you're reading this book and hope you'll change your strategy and make stronger trades as a result. Appendix B, multiple timeframes. AVWAP is a primary part of my analysis, which I integrate into my multiple timeframe analysis. Time is one of the few variables that we can control in our pursuit of market profits. Of course, we cannot control time itself, but we can control our entries and exits and the length of time we choose to hold our trades or investments. The period of time that we allow our market activities to work for or against us is completely subjective. Whether you are a day trader, long-term investor, or somewhere between, the goal is to always cut our losers and hold our winners. The most effective way to achieve this goal is to listen objectively to the message of the market. This is accomplished through technical analysis. Often, the message of the market will be one of confusion, and that is an important message to recognize. If there is no clear trend or potential trade setup, the message of the market is clear. Be patient, cash is a position. We may want to constantly be engaged in the market, but it is better to observe and wait for the fat pitch trade to set up before getting involved in a new trade. Choose your time frame. One of the most important aspects to your success in the markets is to identify and stick to a time frame that is best suited to your personality. Some people are more attracted to day trading in and out of highly volatile stocks, while others may be more interested in a buy and hold approach. I am not the first person to observe that the number of trades one makes will typically decrease over the number of years that you are in the markets. The fact is, some people are great day traders, and that is where they should focus their energy. There are many excellent long-term investors, and that should be their focus. The bottom line is to find the time frame that works best for you. Many traders use a combination of time frames for different strategies. This is how bond managers must work. They diversify their time frames by the purchase of 2, 5, 10, 20 years and longer maturities. They are forced to trade various time frames. Do what works for you and go slow until you figure out the time frame that is most suitable for you. Only you can know the best time frame for your personality, and you will likely make a lot of mistakes as you figure it out. A long-term investor uses the longer-term market exposure to smooth out returns. This requires a tolerance for short-term volatility. Shorter-term traders attempt to exploit the volatile periods for quicker returns and need to make quick and accurate decisions. Because of their shorter time frame focus, shorter-term traders can experience a full cycle of emotions in a single market session that will take longer-term investors years to experience. This leaves shorter-term traders more vulnerable to costly, emotional decisions. Time frame considerations. Are you a fast thinker or slower thinker? Can you quickly observe and objectively make decisions, or do you get panicked when you must act on shorter time frames? Are you a slower, methodical participant who must plot and plan each detail? What suits your personality best? What is your capital base? People with small accounts may feel they have to be more active, while larger account holders may be more patient. How much time do you have to commit to the markets? We need to use even sized bars or candles for accurate analysis. A common mistake made in technical analysis is to use time frames where there are an uneven number of periods each day. This approach unfairly weighs one period over the others, and therefore skews any technical tools we use in our analysis. Take the example with a chart constructed of 60-minute data, the hourly time frame. The market is open from 9:30 a.m. to 4:00 p.m. each day, which is a total of 6.5 hours or 390 minutes. If you were to use a chart constructed of hourly bars candles, you would see 7 periods on the chart, but this would not accurately reflect the price action. If we are to do any analysis of data, we need to make sure we have a consistent data set. If the first period was just 30 minutes, 931,000 a.m., and the rest were 60 minutes, 1100, etc., the data would be flawed. It would be like measuring a standard 12-inch foot with one measurement of 1 centimeter and the other 11 measurements with inches. When you add those 12 units up, it does not equal 12 inches. To obtain equal measurement of price and volume data in our analysis, the number of minutes per candle used must all be divisible into 390. I've demonstrated this in Table B1. Time frame confusion. Trend trades may seem easy when you see a stock in a strong uptrend. Many participants fail to understand that a stock can have multiple trends on different time frames. They only see the longer-term upward trajectory of the stock and overlook any strong pullbacks in the uptrend that can result in quick losses. The remedy to this conflict is to analyze multiple time frames together for a more complete picture. A stock in a longer-term uptrend over the last year may be in a downtrend over the last 2 weeks and may have just begun to turn higher on a shorter-term time frame. These conflicting trends can create time frame confusion or an emotionally driven purchase of a stock after a longer-term move is well underway. The purchase of a stock that has already moved in the near term makes it more difficult to control risk. Focus on the trend, not the label. The media is always focused on whether we are in a bull or bear market. A swing trader's job is to make money regardless of market conditions. While most stocks will trade in line with the trends of the overall market, there are always exceptions. Even in the strongest bull markets, there are periods of weeks to months where the overall environment does not favor new purchases of stocks. In the bearish periods of a bull market, it doesn't make sense to buy stocks that are in near-term downtrends. It is better to either stay on the sidelines in cash and protect your capital or to make tactical short sales. Just the same, in a bear market, some of the fastest short-term moves occur on the upside. Trading these rallies is a risky strategy, and only the most skilled traders should attempt to take advantage of these counter-trend moves. Whenever a trade is taken against the direction of the primary trend, it should be done with smaller risk in position size and less overnight exposure. As we know, stocks in downtrends are considered guilty until proven innocent, which means we do not trust the rally attempts. It is common for inexperienced traders to get excited about a large move higher with a stock in a downtrend. These are typically sucker rallies, as they make a lower high in the short-term trend and then roll back over with a new wave of shares sold by fearful sellers. The stock in chart B2 experienced several strong rallies in the downtrend. 3 highlighted sucker rallies even made it up through the declining AVWAP anchored to the peak, but they failed to break the downward trend. In chart B3, a closer examination on the 30-minute timeframe of the last rally above the AVWAP shows the better trade opportunity was to short the stock at the green highlighted area, where the stock made a lower low below the AVWAP anchored to the start of the rally. Price targets? Once I have determined if it looks like there is potential for profit relative to the perceived risk, I prefer not to stay focused on a price target, but to listen to the stock to tell me when to exit. Many people focus too much on an upside target and tell the market what they want for a profit. As a result, they fail to listen to the message of the market. The market does not honor target requests, and a profitable trade can turn into a loser if we stubbornly wait for the stock to hit our target. Once I have determined my risk-reward ratio, my price targets are higher for longs and lower for shorts. Our job is to listen to the market, adjust, and raise our stops to protect our gains as the price progresses in the trend. Multiple time frame analysis. Our analysis should begin with a chart constructed of daily price history for the last year or so. This time frame is simply to make sure our trade candidate is in a primary uptrend for longs or downtrend for shorts. We want to be sure there aren't any large potential levels of resistance or support nearby that might slow or halt the momentum. Trend alignment. We want to get involved in the stock as the intermediate term trend, days to weeks, comes into alignment with the longer, more powerful trend. This approach allows us to enter the longer term trend as the intermediate term trend develops. When the trends of various time frames move in the same direction, they are aligned. The goal is to find the ideal point of entry, set our initial stop loss, and then to manage our winners. Many of the strategies we have explored are guided by this very concept. The strategies section covered the use of shorter time frames to fine-tune our entry points. Multiple time frame trend alignment gives us a greater confidence of trend continuation, and that allows us to be more aggressive in our position size. Determination of the size of a trade is based largely on where we enter a trend and how we can control our perceived risk. Besides the location of our trade entry, other reasons to adjust position size would include overall market conditions, news risks such as upcoming earnings reports or a Fed meeting, and even our own personal well-being. To become proficient at trend alignment strategies, make it a habit to look at stocks on multiple time frames to gain a better comprehension of how the time frames flow together. Observe how trends from shorter time frames coexist, interact, and build upon the longer-term market structure. One tenet of technical analysis is, a trend once established is more likely to continue than reverse. The long-term trend is the sum of many shorter-term trends, therefore, we need to wait for evidence the trends are back in alignment before we get involved. The longer term and the 50-day moving average, when in doubt, zoom out ~JC. Parrots? Always be aware of the longer time frame, even if you do not plan to hold a stock for a long while. The longer-term trends should be respected as it takes a lot of energy in the opposite direction to reverse them. Defer to the longer and more powerful trend if in doubt. If the long-term trend is up, give the benefit of doubt to the bulls and vice versa. Longer time frames offer greater opportunity for profit, while shorter-term time frames offer the fastest, more seductive opportunity to turn a quick profit. If you cannot find clarity on a longer time frame, interpret it as the market telling you to avoid the stock for now. Cash is a position. When uncertainty reigns, cash affords you the objective position to wait for your signals for a low-risk entry. As you get better at timelier entries with multiple time frames, your profitability increase, and you will also find satisfaction from not buying a stock that continues lower. Quick and easy reference point to determine the primary trend is the slope of the 50-day moving average, DMA. If the stock is above a rising 50 DMA, consider it innocent until proven guilty and therefore is a candidate for a long trade. If the stock is below a 50 DMA that is sloped lower, it is guilty until proven innocent. Avoid these latter stocks from the long side or consider them as a candidate for a short sale. When a stock crosses above and below a flat 50 DMA, it shows us a trendless stock that offers no advantage for a long or short sale. The message of the market is clear in these instances. These stocks should be avoided. The direction of the 50 DMA is an efficient way to be sure we know the trend of the stock on the longer time frame. All moving averages should be used as a reference point to compare price trends. They should not be considered as automatic levels to do business when they are touched, but rather as a reason to observe the price action on a shorter-term time frame where we formulate a plan. We generally give the benefit of doubt to buyers when the 50 DMA trend is higher and to the sellers when the slope is lower. Note, the charts are for the same stock. On the left, chart B4 shows the weekly moving average over a 10-week period, while chart B5 is the 50-day moving average. The increased detail in chart B5 arises from that fact that there are 5 trade days per week. Once we have identified the trend on the daily time frame, the next step is to analyze the intermediate term time frame for clues of a possible low-risk, high-probability trade set up. Intermediate term and the 5-day moving average. An intermediate term time frame helps us to determine if there is a trade setting up in a low-risk manner. This time frame allows us to enter the stock as price momentum comes into alignment with the longer time frame. For the intermediate term trend, I prefer to use a 30-minute time frame for a period of approximately 25-40 days, with a 5-day moving average, 5 DMA, as a trend reference point in a similar way to how we use the 50 DMA on a daily time frame. Note, do not confuse the 5-day moving average with a 5-period moving average. You cannot just set the moving average to 5 on any time frame and see the 5 DMA. It is a 5 DMA only when the chart is constructed of daily candles. The only time you will observe a true 5 DMA on a daily time frame is when the market is closed. Prior to the close, it will only be 4 full days plus whatever part of the day has elapsed since the open. To compensate for this, I never look at the 5 DMA on a daily time frame, only on shorter intraday time frames. Here is how we accomplish this. Notice that the location of the moving average for the same stock on different time frames is in the same location and has the same slope. We want to keep our analysis consistent across various time frames, so we convert the daily moving average to intraday time frames with this handy table, B7. As noted earlier in the chapter, the market is open 390 minutes per day. Over 5 days, it is open for 1950 minutes. For example, if we look at the market on a 65-minute time frame, that means we want to use a 30-period moving average to replicate the average over the last 5 days. 1950 minutes per day divided by our 30-minute time frame equals 65 periods. On a 15-minute time frame, the 5 DMA is represented by 130 periods. 1950 divided by 15 equals 130. A little bit of simple math allows us to keep consistency of our analysis in relation to 5 DMA on various time frames. Combine time frames for longs. The breakdown below outlines how we want to analyze the intermediate term trends to plan our trade. When a stock is in a longer-term uptrend, we then look to a shorter time frame for trend alignment. Stage 1 accumulation. This is where we plan our trades. We observe, analyze, and anticipate the point where buyers will take control. This is the time to assess our price objectives and stop levels to determine our plan of action for when the stock gives us a reason to get involved. This is when we want to answer, where has the stock come from and where it has the potential to go. Then we can determine if there is a sufficient risk and reward ratio setting up to justify the purchase of a new long trade. If the 5 DMA is in decline or beginning to flatten out, that is a clue to leave our activities to analysis and not take action at this stage. Stage 2 markup uptrend. As the stock makes a short-term higher high, which is in alignment with the longer-term uptrend, we want to buy the stock. This is when we participate in what appears to be a continuation of the uptrend on the longer-term time frame. Stage 2 is also where we manage our winners by raising the stop to just under successive higher lows as the stock rallies. This is the fun part. The 5 DMA should be flat or starting to advance at this stage. We generally want to buy the stock as it makes its first higher high on this time frame. Stage 3 distribution. This is when the stock shows signs of fatigue and may proceed a price pullback, or it may need a correction through time. This is a good point to exit the position, or at least sell some to lock in partial profits, and tighten the stop on the balance, rather than continue to expose our capital to risk. The angle of ascent of the 5 DMA will slow down or begin to turn sideways at this point. Stage 4 decline, downtrend. Once the definition of a trend, higher highs and higher lows, no longer exists on the time frame when we entered the stock, there is no reason for a swing trader to continue to hold. When the primary trend is higher, it is likely that the breakdown of price into an intermediate-term downtrend is the start of a pullback, not a longer-term reversal. This means that the odds do not favor profitable short sales. It is better to avoid these stocks and look for better setups elsewhere. In Chart B8, we see the daily chart with 50 DMA, and in Chart B9 the same data on a 65-minute time frame with 5-day or 30-period MA. It should be easy to see why the use of more than one time frame allows us much greater accuracy to determine where the trend of the daily and intraday time frames become aligned. The numbers on the chart B9 are the shorter-term trend. Notice on the 65-minute time frame, substages can be skipped by the stock. We always give the benefit of the doubt to the longer-term time frame. Combined time frames for shorts. The approach to short sales is the exact opposite. We start with a stage 4 decline stock on the daily time frame and then look to the intermediate-term time frame in this way, stage 1 accumulation. This is where we exit our short sale trades. This is when the stock shows signs of fatigue. It may proceed a price bounce, or it may need a correction through time. This is a good point to exit the position, or at least buy some back to lock in partial profits, and tighten the stop on the balance, rather than continue to expose our capital to risk. The angle of descent of the 5 DMA will slow down or begin to turn sideways at this time. Stage 2 markup uptrend. Once the definition of a trend, lower highs and lower lows, no longer exists on the time frame we entered the stock, there is no reason for a swing trader to continue to be short. When the primary trend is lower, it is likely that the breakout of price into an intermediate-term uptrend is the beginning of a bounce, not a longer-term reversal. This means the odds do not favor profitable short sales. It is better to avoid these stocks and look for better setups where trends are coming into alignment on the downside. Stage 3 distribution. This is when the stock shows signs of fatigue and may proceed a price decline. In the short-term stage 3, we observe, analyze, and anticipate the point where sellers will take control. This is the time to assess our price objectives and stop levels to determine our plan of action when the stock gives us a reason to get involved. This is when we want to be sure we have answered. Where has the stock come from and where it has the potential to go? We can then determine if there is sufficient risk and reward ratio setting up to justify a short sale trade. Stage 4 decline downtrend. As the stock makes a short-term lower low, which is in alignment with the longer-term downtrend, we want to sell the stock short. This is when we participate in what appears to be a continuation of the downtrend on the longer-term time frame. Stage 4 is also where we manage our winners by lowering the stop just above successive lower highs as the stock declines. This is the fun part. The 5 DMA should be flat or starting to decline at the start of this stage, and we generally want to short the stock as it makes its first lower low on this time frame. When the primary trend on the daily time frame is lower, we avoid longs and consider short sales. The 65-minute chart on the right shows us the various action points we want to take based on the substages. We want to participate in short sales when the shorter-term trends are aligned with the longer-term trend. Steps for multiple time frame analysis. 1. Identify the stock as a long or short candidate with the daily time frame. Do not fight the direction of the 50-day moving average. 2. Consult the intermediate-term time frame to establish whether the potential profit is worth the perceived risk. Do not fight the direction of the 5-day moving average. 3. Consult a shorter time frame to fine-tune the entry. Multiple time frame analysis checklist. Be aware of the trends on multiple time frames. Are the trends aligned or do they show confusion? How do time frames fit together, or do they diverge? The greater the number of time frames you study to confirm the trend, the greater the probability that your trade will succeed. Price action that moves against the larger time frame tends to reverse back into alignment. Use a minimum of 3 different time frames for analysis. There is a tendency for traders to feel as if they must be continually engaged in an active position. But when there are mixed trend signals across various time frames, it is best to have a more cautious stance until trends align and show lower risk entries. Cash is a position. Time frame transition. Common wisdom says to stick to the time frame you intended at the onset of your trade, and for good reason. All too often, short-term traders will find a reason to justify hanging onto an unprofitable trade longer than originally planned. Similarly, someone who intends to hold a stock for the long term should fight the urge to take a quick profit. The only time you should allow a short-term trade to be transitioned to a longer time frame is if the stock is in a profitable position, and you can still manage risk for the trade. It is acceptable to start a trade as a day trade, and when the stock moves in your favor, take some of the risk off with the sale of a piece of it, and then hold the balance for gains into the next day or coming days. For a longer-term investor, the only reason to cut the trade early is to protect capital if the story has changed or if the stop loss is violated. The decision to hold longer than expected should be made from a position of strength, not weakness. We always want to protect capital first and then maximize the gains if the market allows it. It is said that bulls and bears make money and pigs get slaughtered. I have updated that phrase to bulls and bears make money, greedy pigs get slaughtered, and disciplined pigs get rich. If your goal is large gains, do it in a disciplined way. Simplicity is the ultimate sophistication. Leonardo da Vinci.
Thank you for listening. We truly appreciate you spending your time with us here on Trading for Life. If you found value in this audiobook, don't forget to like, share, and subscribe. Your support helps us continue bringing powerful and inspiring books to you. And this is just the beginning. We've got more audiobooks coming your way in the days ahead. So be sure to check back soon and keep growing with us. Until next time, take care. And stay focused on becoming the best version of yourself.